you would have on the laptop, okay, you'll have this screen, and then over here on the top right, if you click that button, then you'll have the settings menu, and then if you click settings, then you'll have audio here, and then if you click audio, you can do the test. Right, so obviously I'm speaking,
Okay.
and my mic is working. So I'm using a USB mic, and obviously other speakers, but you can see that this is what you need to check. So in future, just check it, just to make sure what is the problem, because obviously if you're talking and you're using Zoom, you just need to look at that button there, okay, or that menu. Yeah, this
Okay.
one. Input level. This should be going up and down, indicating that the mic is obviously working. You can test your mic, you can test your speakers. So I heard your speakers were fine because I heard that music in the background. So your speakers are
Yes.
working, but obviously there's a problem here. All right, and then if you click this, you can select different options. So I can use the PC mic, which is this option. I can use the audio, the USB mic. So those are my options. So obviously, depending on what device you've plugged in. Sometimes, if you're plugging in a headphone, sometimes not all headphones have a microphone. So that's what I thought it was, because when you had speakers here, okay, you can also use your headphone for the speakers. So that's what I saw earlier. I saw headphones here on your laptop. But obviously,
Yeah.
if your headphones are being used for the speaker, the headphones might not have a mic, and then obviously the computer can't pick that up. So yeah, I don't know what the problem is. You just need to test it and just play with it, just to see what works. And then once you've got the right settings, then just save the settings and keep the settings as is, and then it should work every time you use the platform. Yeah, so just when you log into it, you'll have a screen that looks like this, and then at the top right you'll have settings, and then just do the test. So at least then you can fix your microphone.
But it was just odd because I always use this laptop
Yeah, that's very
and these
strange.
headphones for like all of our meetings. So,
Yeah, that's very strange. So
and I'm using the headphones right now on my iPad and you can hear me fine. So I don't know what happened.
okay, but yeah, there's definitely a. I mean, yeah, you just need to do the test. So just do the test in future before we start. Maybe just double check to make sure that everything's working, and you can do that here. You can actually see. You can actually see this bar go up and down. If the bar doesn't work, which we saw, then there's a problem with the mic.
Yeah. Okay.
Okay, then it's just settings or something. Then maybe switch off the computer, put it back on, and then see if it works. Because maybe it's just that. But yeah, you just need a
Okay.
test. So every time you log into Zoom, just do that check. Check the speakers, check the mic, make sure that you can hear, and make sure that you can record your audio, and then it should be okay. All right, but it's
Okay.
fine now. At least we've got you have your iPad, so you can actually still see what's going on. Okay, so let's just move that across. Okay, and let's start with the recap. Okay, so which of those examples did you struggle with? Did you go through all of them?
You said I must do the
The workings?
workings.
Yes. But did you
Yes.
look at exercise two? Because exercise two were those basic, simple sole proprietor questions. These ones.
I did exercise too.
Yeah, we didn't do all of them. We did one, which was from start to finish, and then you had a few others that
Yes.
you could have practiced, you could have looked at. I think this was the
Yes,
one
and
that we looked at. Let's go to your. Let me go to the. Okay, so we had looked at. This was exercise sole proprietor. Where's the disclosure here? This was the disclosure. We looked at 2.2. That one I did with you.
yes.
Did you go through any of the others? Did you try do more of them? 2.1 you could have looked at. 2.3 you could have looked at. Did you go through them?
I I did 2.3 and I did email it to you.
Okay, was it just. When did you email it? Was
It
it
was this
now?
one. Yeah, it was right now.
Okay, all right. I'm not going to open that now. I want to ask you if you had any problems with it. So did you check? Did you check your
Yes, and
answer with their answer, and how did it go?
I did, and I got it right. I didn't have any problems with 2.3.
Okay, so 2.1 and 2.2 seems to be okay then in terms of normal disclosure. This is normal disclosure that would
Yes.
have been covered in 1502. It's revision and they've included in your 1601. Are you happy with that one?
Yes.
Okay, so that section's fine. All right, so let's focus on the new work then, because that's old work. That's
Yes.
1502 work. Okay, study unit 3 or learning unit 3 is looking at partnerships. So we covered theory last week. I did one with you, and then you had to do workings for the others. So let's have a look at the disclosure. 3.1 we did, that was the long question. 3.2
Yes.
and 3, where is it? Here's it here at the bottom. After this, there's it. Okay, so exercise 3.2. All right, so you had to do workings for the adjustments, and then we have to look at the disclosure. All right, so let's look at disclosure. Let's copy paste our disclosure here. Actually, let's just make a new sheet.
I just have a question. Why do partners get interest on capital?
Because it's the compensation for investing, so it's agreed between the partners. So if you are going to give capital to your partnership and your partner isn't, surely you should be compensated for taking on that risk.
Okay.
Okay, because it's money that you
Okay.
are putting into the business, and if someone else isn't putting money into the business and you are taking that risk, you could have taken that money and put it into a bank account and earn interest.
Okay.
All right, so that's theory, and that comes from the actual textbook where they talk about the reasons why you would want to include interest on the actual agreement. Remember, this is terms and conditions. Remember that contract you have to sign, that agreement?
Yes.
That agreement is signed between the partners. And if the partners
Okay.
agree that interest will be applicable on accounts that they have with the partnership, then both have to agree, both have to sign the contract, and both have to then apply that with the accounting.
Okay.
Okay, so let's label these. This was 3.1. 3.1. Okay, this is 3.2. All right, so 3.2. Let's delete all the... Okay, so I'm just using the templates. Okay, so there's the template for 3.2. Right, there we go. Delete all of that. Delete that, delete that. Okay, there. All right, so we'll update the format to look at the disclosure. But that's what you need for every question. It doesn't matter what question you've been given. I see the internet here. I'm getting this message. Let me just check here quick. Why is it slow? Okay, it's fine now. Oh, that's odd.
Is it my internet or is it yours?
It might be mine if I get that window popping up. But I can hear you fine.
Oh.
It might just be maybe something downloading in the background maybe that's slowing it down. All right, but it's fine. As long as you can hear me, it's
Yes.
clear, right?
I
And you
can.
can see the screen.
Yes. Yes.
Okay, awesome. That's important. Okay, great. All right, so exercise 3.2. Go to the textbook. Have a look at it. Okay. Remember, you need to take all the important bits and pieces of information and you need to reference it in your actual disclosure answer. All right, so obviously you've got two partners here, Toy and Porky, T and P. Okay, I'm just going to use T and P. T
Okay.
and P. It's easier than, those are weird names. Okay, Toy, Porky, don't know where they got that from, but anyway. Okay, T and P. Okay, so there you go. I've updated the statement of change in equity. You know that when looking at disclosure for partnerships, the disclosure for the SOCI is going to be important because of appropriation. You're sharing the benefits of the partnership with the partners. Okay, so you've got T and you've got P. Do they tell us what the ratio is? No, they don't. All right, so your job is to go through the information and to identify what's important. All right, so what's important here? Sales. Do I have sales? Yes.
Yes.
Okay, so in terms of
Come
disclosure,
free.
you have to insert the 97,600. Settlement discount received. Okay, remember, UNISA is going to probably take this discount off either cost of sales or sales. This is a discount that you've received, so it's going to affect your purchases.
Yes, so cost of sales.
Yeah, normally I would prefer showing it separately, but you can take it off cost of sales. It's not going to change the working, but cost of sales has its own formula, which is separate because
Yes.
it's periodic. Right, so I'm going to record settlement discount received as income, but as a separate income line item. Okay, if they group it, then I'll group it, but I'm going to show it separately just so you can see the separate workings.
Okay.
Okay, next, purchases returns. Now I need cost of sales in terms of workings. Opening stock plus purchases minus returns. What are the returns here? 850.
Yes.
Okay, that's basics from 1502. All right, admin expenses. 33,750. Sales returns.
860.
Purchases. 44,000.
44. Yes.
Credit losses.
2440.
Okay, let's carry on. Drawings. Okay, drawings go here. All right,
Yes.
what was this? This was for balances at February 15. February 15. Disclosure is for what month? February 15. All right, so we can assume that based on what we have in the required and based on what we read here, these are balances, okay, before adjustments, but at year end.
Yes.
So balance at the end of the year, okay, for drawings, it was T
For T 3880.
P
And for
1800.
P
There we go.
1008. Yes.
Okay, drawings. We've got depreciation is an expense.
Yes.
Depreciation 3940. Land and buildings is an asset. Okay, the land and buildings 20,000. Okay, see, this is how I would do it from start to finish as practice. Okay, so obviously you're going through theory to cover what you need in terms of this, the SOCI. Okay, the SOCI is the part that you're probably going to struggle with. This you can probably do. Statement of
Yes.
comprehensive income, statement of financial position, because that's 1502. Okay. Motor vehicles, 36.
Yes.
Furniture and fittings, 12. Inventory, there we go. Inventory 1st March is opening stock. Do you see that?
Yes.
Okay, opening
21.
stock 21, 530.
Yes.
Trade receivables control, current assets.
Current assets. 23,520.
Great. Allowance for settlement discount received. Okay, this is an allowance for a future discount. Discounts are received from who?
Suppliers.
Yes. Okay, so here you've got an allowance for discounts that will affect your trade payables. Does that make sense?
So this will affect our trade. Okay.
Okay, why?
Okay.
Because who do you receive discounts from?
People that we owe.
Exactly. Good. All right, so keep it simple. Just think about it logically. Discounts received arise with who? Creditors.
Yes.
Okay, so I don't know what the balance is. So question mark. What is the amount?
Okay.
400, eh? Yeah.
400.
Okay, be careful. Minus. What else does the question give you? Current accounts. Okay, so go across. SOCI disclosure here. Ooh. I want to resize it there. Okay. There we go. Okay, so in the SOCI, I've got current account toy. Okay, this is for March. It's at the beginning of the year, so it's going to go here. Is it a debit balance? It is a debit, so it's a minus. Okay, Porky, minus 600. Also, opening balances on their current accounts. Okay, what else do we have? Capital. Toy.
Capital.
Okay, this is at the beginning. Look at the date. Very careful.
Yes.
Be careful. Look at the date.
So it's
40.
beginning. Yes.
20. Okay, what else? Let's see. Bank overdraft. Okay, scroll across. Liability. $4922. Okay,
Yes.
accumulated depreciation, furniture and fittings. Go up. Furniture and fittings minus 5298.
Yes.
The motor vehicles 14800.
40. Mm-hmm.
The allowance of settlement discount granted. Who does that affect? Your debtors. Does it make sense? Discounts are granted to your debtors, right?
Yes.
Okay. What else? Allowance for credit losses. Allowance for credit losses comes off your debtors. So trade receivables minus 2,300. Okay, it's an allowance for bad debts. Trade payables control account 17,500. Okay, earlier I didn't have a figure here. Now I have it. 17,500. Okay, those are easy marks. If this was a written exam, that's what I would do in the exam. Okay, I would go through each and every line item and I would ask myself, where do I disclose this information? Because in 1601, everything is about disclosure. That's why you have to have these templates. You have to know where to put what. Right? Are you okay with that?
Okay. Yes.
Okay, yeah, that's important because those are basics that you need to know from 1502. Then you need to look at stuff that relates to 1601. Okay, so additional information, Toy and Porky, okay, share profits and loss in ratio 2:1. Okay, so now we know how they're going to split this profit.
So it's
Okay,
going to be
profit
2 over
sharing,
3.
2:1. All right, so that tells me
Okay.
that T is going to get 2 over 3
Yes.
and P
And
is
P.
going to get 1 over 3. Does that make sense?
Yes. Yes.
Okay, double check. Read it again carefully just so we don't make mistakes. 2:1. So Toy gets 2, yes. P gets 1, good. Okay, fine. All right, number 2. On Feb, salaries and or services rendered, salaries for services rendered according to the partnership agreement were paid to the partners as follows. All right, are these salaries normal salaries and wages that you would show in an income statement?
I would say no.
Of course not. Good. Okay, that's the correct understanding because remember, this is looking at the partnership. What is the partnership worth in terms of its financial position and what did they generate in terms of income and expenses? Right, this is a partner specific transaction. And when we spoke about partner specific transactions, we said it goes in the SOCI because it relates to the partners. Right, so salaries for partners.
Okay.
Okay. Who gets what? Okay, T gets 6, Porky gets 4.
So
All right, so this would
1,000.
affect their current
4.
account because they're entitled to the salary. So 6,000, okay, would increase the current account for Toy, and Porky gets 4. All right, and obviously, who has to carry that cost? The burden of the cost goes to the partnership. So the appropriation account will be affected. They'll be able to share less. They won't be able to share more. Does that make sense?
So, so the appropriation account is similar to the profit and loss for a sole
Correct.
proprietor.
Yeah, the appropriation account
Okay.
can actually be drawn up like a T account, and then you'll have debits and credits on both sides. It's a working
Okay.
account, yeah. That's correct.
Okay.
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 Both these amounts were recorded as admin expenses. Do you record those salaries as admin expenses? No. You cannot show it as an admin expense because it's not a normal expense. Does that make sense?
Yes. But
Okay,
why would
so
they say that?
pardon?
So why would they
Why would
give
they
us
say that? Because
information
you have to
say?
adjust your disclosure. Admin expenses has 33,750. Can you show partners' salaries as part of admin expenses? No. That's what I've read here. Okay, you told me earlier that the salaries cannot be recorded as a normal expense. So why would you show it in the income statement?
You wouldn't. So why is there 10,000 there?
Why is there 10,000 there? Because I have to take it out. Because it's included. Both of these amounts are recorded as
Uh,
admin expenses.
okay. All right. Okay.
Okay,
Okay.
they're
I get what they
telling me
did.
that they
They,
recorded it. Do you see that?
okay.
Both
Yes.
these amounts were recorded. So should they be recorded? No, they shouldn't. Should I take
No.
it out? Yes, I
Okay.
should.
Okay. I get it now. I get
Okay.
it.
Number three,
So
interest on
that's
the.
like tricking.
It is tricky. Yeah, you have to read carefully.
Yeah.
Yeah. Okay,
Okay.
I'm just going through it carefully because last week I made two mistakes and it's not good. So I want to just make sure that I'm reading it correctly.
Okay.
Okay. All right. Number three says interest on partners' capital accounts amounted to. Okay, so they're telling me that there's interest on capital, which is a partner-specific transaction. Right, it must go there. All right, what does interest do to their current account? It increases their current account because they're entitled to
Yes.
more. All right, so let's read it again. Interest on partners' capital account amounted to 2-1. Okay, 2140. Okay, and toy 1070. Okay, no, toy was 2140. Porky was
2140. Yes.
1070. Okay, so
Yes.
that's going to increase their account to show that. Right, 2140. Okay, and 1070. All right, the interest is applicable on their current account. It's going to increase and it's due on their capital. Okay, fine. All right, who's going to, inverted commas, pay for this? The partnership. So the partnership will have the total. All right, minus the two amounts. Add them together. All right, so I've used Excel to add up. Minus gives you negative 3210. Okay, because the partnership is
Okay.
going to be, inverted commas, paying for that interest on capital. Okay, the more interest they get, the less there will be in the partnership. Okay, number 4 is the closing stock. What did you
In,
do with number 4?
so what I did was I debited inventory
Yes,
because your asset would increase, and I credited cost of sales.
correct. No. You wouldn't. Well, if you're crediting cost of sales, you're actually subtracting it. That's bad. Okay,
But then it's closing.
it's a closing transfer. So you're actually crediting your trading account. Because remember, in trading account, you
Oh,
work out cost of sales.
okay.
Okay, because if you're thinking
So then
about the periodic system will have a trading account that would calculate cost of sales and sales to work out gross profits.
okay, I get what
Okay,
you're
so
saying.
if you're looking
So
at a
what would,
closing transfer, the closing transfer would be to credit the cost of sales to close it off, but to close it off to the trading account.
so what would I, so what would it be? So I debit inventory and credit?
If you're debiting inventory, you would credit the trading accounts
But
because
then,
cost of sales will be calculated in the trading account. There won't be a cost of sales account for a periodic system anyway.
okay, but what would my element be then?
What would your
If
element
I,
be? Your element would it wouldn't be a journal entry. It would just be a calculation because remember this
okay.
is a periodic system. So with a periodic system, cost of sales isn't a transaction. Cost of sales is a working.
Okay.
Okay, it's a working that gets done either on the face of the actual statement, which I'm doing here as a formula, or in a T account.
Okay.
Okay, so as long as you remember the formula, opening stock plus purchases minus returns minus closing stock. As long as you've got the negative 19,100, that's fine.
Okay.
Okay. All right, and then depreciation amounted to that. Okay, what is your working for this one?
Did you add it to assets?
Add what to assets?
Your inventory.
Inventory, we need to disclose it. Where
So
was
you
our
disclosed
inventory?
it.
Okay, yeah, we
Yeah,
didn't
so
have
you need
inventory.
to
We
add
need to
it.
show closing inventory. Yeah, that's correct.
Yeah. Okay.
Inventory would be 19,100. Yeah.
19,100. Okay.
Okay. All right. Depreciation. What did you do with this?
So I debited depreciation.
Yes.
So your expenses,
Good.
and then I credited accumulated depreciation.
Yes. So there's the debits. You've got them. Now we need to show those credits that you had. Okay. So what do we have
Yes.
here? Depreciation for furniture and fittings. There's furniture and fittings minus 940. Okay. Vehicles minus 3. Happy with that?
Yes.
Okay, and that's it. There's the end of the required. Okay, so now you need to work it out. Okay, so sales, work it out. Cost of sales, work it out. Okay, gross profit is the difference. That minus that. Okay, other income here. Okay, admin. Credit losses. Depreciation. Okay, other expenses, sum up. Okay, there's the sum. Profit for the year. Okay, your gross profits plus your other income minus your expenses. All right, so profit for the year, okay, in terms of what this business has, okay, the admin expenses is going to be the 18,540. Okay, because we had the gross profit plus the other income minus the other expenses. Okay, so we had admin here, we subtracted admin, we had our credit losses, and we had our depreciation that we had to provide for. Okay, so let's go back to the disclosure. Okay. Profit for the year. That amount. Okay, taken to the SOCI. Right, so do you agree the partners are going to share profit of
Yes.
18,540? But that
No,
profit that
yeah.
they're going to share is going to have to take the salaries and the interest into consideration, because only what's left over will be shared between the partners in their profit sharing ratio. Does that make sense?
Yes.
Okay, so when I have an appropriation account, because it's a working account, okay, it always has no balance, because you work it out, it's zero. So you'll see zero here at the end. All right, so literally, there's going to be a working here that you'd have to do, okay, to allocate or to appropriate the profits. Okay, we know there's a profit. Okay, so what's the difference? This minus that gives me 5330, which is going to be shared. Okay, amongst the partners. That will be a debit. Okay, you would obviously subtract it from the profit and you would allocate that to the current account. All right, so Toy gets 2/3 of this. Okay, and Porky gets 1/3 of that. All right, so that's what you've got. All right, let's just round it off. So it's a nice round figure there. Okay, I've appropriate the profit, or appropriation of profits. Appropriation of profits. Right, so now we can work out the balances. Okay, round it off. And then this didn't change. No additional capital. Alright, so remember those balances get disclosed on the face of the statement of financial position. I'm going to keep it all separate. You can close them off to capital. You can just have capital plus the current account minus the drawings, and you can just have one line item. Okay, I'm going to show it separately here. Okay, so capital, add the 2. Capital will be Toy plus Porky. Current account, those 2. Sum up. Sum up. Okay, drawings is negative. Sum up. Okay, so now we need to wrap up this section. Right, we've done that. We need to look at this.
I have a question.
Yeah?
For the statement of changes in equities, when we do it for a sole proprietor, we always have capital at the end. So why don't we do it for this statement?
Well, if it was a sole proprietor, you would only have this. It would just look like this. That's all you would have for sole proprietor. And then you wouldn't have any of that. You wouldn't have any of that. Okay, for a sole proprietor, you would have this. Balance at the beginning. So if the capital was 10,000, okay, and the business made a profit of 18,540, okay, you would have less drawings. And then it would have been, let's say, minus 5,000. And then your balance at the end would have been the total. Okay, that's the sole proprietor. Because the sole proprietor doesn't have to share the profit.
Okay, but we have like a balance at the end where we take our capital minus our drawings plus our profit. So why don't they show it like that for partners?
Well, if it was the same, then you can just... so with the disclosure, you can show more or you can show less. Right, so here I'm showing more as a working. Okay, remember my second column is a working column. And then in equity, notice equity is showing the exact same thing. Capital plus current minus drawings.
Yeah, no, I get it. I get what you're saying. But then I just wanted to know, why don't they calculate it in your statement of changes of
Why
equity?
don't they calculate it in the statement of changes in equity?
Yeah, like
why don't they show it
we
here?
have like a line?
Because each of these are separate accounts. This is long term, this is short term. Okay, remember that distinction we made in the notes? Long term is looking at the capital that was invested. Current account is what you're deriving from the partnership over time. Okay. So these are workings columns. It's disclosure. Remember, IFRS says you have to disclose the information for users to use. This is the disclosure that's required for a partnership looking at the statement of changes in equity. Because equity for a partnership needs to be disclosed for each and every partner, for everything.
Okay.
You can close this off to current account, but then you'd have to show a minus here. And you'd have to show a minus here. And then you'd have to show the beginning, which would have been the 3880. And then you would have shown closed off here. Right, you can close it off, but I don't show the close off because I'm keeping it as is. Right, because disclosure, you have to show all those different things.
Okay.
Yeah, so in a test question, you always have to show everything. So you need to show as much detail as possible because they'll give you working marks for these columns. Right, drawings, if they tell you the drawings were taken during the business's financial year, then I can close off the drawings because it's closed. Because for that year, I'm saying, well, current account was this, and then minus the drawings gives me a new balance. That's fine. Okay. But capital is capital, current is current. Those two have to stay separate.
Yes.
Okay, if
Yes.
you want to show total, then you can just add everything up and you can just show a total column. The total column will just add up everything. The total column would add up all of that, so you'd minus and add here. Does that make sense?
Yeah, I get what you're saying.
Okay, but then that's just a total. That's just adding and subtracting. If you want to add and subtract, it's not going to change the disclosure. It's going to add more. That's all. All right, so then I would just add up lengthwise. Sum up lengthwise, that way. Okay, add up that, 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 add up. That's all. Is that all right?
Yeah.
Okay. All right, so yeah, you can show more totals if you want to, but that total is never ever going to carry any marks because then you're going to get the
Okay.
marks here for disclosure because those things have to be adjusted for or provided for in the question. Appropriation will definitely have marks. Okay?
Yeah.
All right. Okay, so coming back to here. Add and subtract. Okay, total assets. Sum up non-current and current. There's the total. Okay, and then you're going to check that with what you have here at the bottom. All right, non-current assets, you didn't have any here. Not assets, liabilities. Current liabilities, you did. Okay, total liabilities, only the current. Okay, equity and liabilities, this plus that. It's not working out. Something's wrong. Let's see. Did I add correctly? Did I subtract correctly? This is a negative. That's a negative. Equity. It's not balancing. Let's see. What's wrong? How much am I out of? Let's see. This minus that.
You mind it? Oh, it's the 10,000.
Oh, 10,000. Okay,
It's the
where was the 10,000?
from the admin.
Yes, there's the admin. Okay, the admin expenses.
But then
10,000. What did they say in the question? Was that recorded? Let's go look. Let's see. Okay, dish information here. Okay, they tell you that the 10,000 agreed to pay the following partners as follows. Both these amounts were recorded as admin expenses. Yeah, okay, so if they're both recorded as admin expenses, you'd have to remove it. Okay, so if I remove the admin expenses, I'm going to take it out from admin. Okay, and this was what? The salaries and wage for partners, which I've included here. There's the salaries and salaries to partners, the 6 and the 4. So the 10 is there. What else do we see here? I suspect it's drawings. So because remember, if this was salaries, you need to make an assumption here because the drawings will change then. Because remember, how do partners get their salaries and wages? They draw it. Does that make sense?
Yeah, but the last time we didn't record it as drawings when we had salaries.
Because they have to tell you if it's paid to partners or not. See, here it said it was paid to partners. Do you see that?
Yeah.
Okay, so how do you pay partners their salaries? By drawing it.
Okay.
Okay, so see that is the confirmation. That tells me that I've paid the partners. So how do you pay partners? You credit the bank and you debit the drawings.
Yeah.
Okay, so yeah, so if we're looking at that, the 10,000 needs to be accounted for here as a payment. Paid salaries as drawings. All right, so I need to show that because there was nothing in drawings, but now there will be.
But then would we not, but if we do it that way, would we not also need to take out from bank?
No, because they said it was paid. It was the record keeping that was wrong. The admin expenses were affected. So basically what they did is they debited admin expenses instead of debiting drawings. Do you see that? Here's the working on the right.
Okay.
Okay, so what UNISA is saying in their addition information is they tell us that they paid the partners the following, but they didn't record it as drawings, they recorded it as admin expenses. So you debited admin, you credited bank. Instead of debiting drawings and crediting bank.
Okay, so that's why we minused it from expenses and we're going to put it under drawings. Okay, I get you.
Okay, so that's what we're looking at here because I'm going back and I'm looking at this because it's not balancing, so there has to be 10,000 and obviously the 10,000 looks at this bit. All right, so I have to show that here as a payment. Okay, so the payment is going to be recorded. Okay, so these balances actually need to go here. Those are opening balances, not closing balances. All right, the closing balances need to update. The drawings, how much was the drawings? P took 6. No, T took 6. P took 4. Okay.
Oh, you have 6 and 6.
There we go. All right, so the total here will change some. There, sum up. All right, so there you go. Now you've got updated drawings figures. Now our statement of financial position should be perfect. Okay, there, the drawings needs to change. Where's it here? There's the drawings. All right, the current account needs to change. Okay, and then we need to update. All right, so the equity is going to be the sum of those two amounts. And then I still get, is it still 10 out? Looks like it. It does look like it's out. So then your assumption would be correct to show the bank here. Because then the bank would be reducing. Do we have bank here? No, you don't have bank here. Do you see that? There's no bank here.
Yes.
All right, so, okay, I see what you were saying earlier when you asked about bank. Yeah, bank would then be an overdraft. Okay, because then that wouldn't have been provided for. Asterisk. Okay, no bank balance provided. So then you would have to show a bank overdraft figure of 10,000. Bank overdraft is not a current asset, it's a liability. Oh, here's it. There's it. There's the bank overdraft. Okay, yeah, so then your assumption would be to add 10,000.
10,000.
Okay, but then it's an asterisk, assuming this wasn't recorded in the books of the business. Right, so that 10,000 was omitted, and then if I bring in 10,000 here, then it will balance. Yeah, okay, so let's go back. Did they say it was recorded here? Were paid. If it was paid, yeah, I would think if it was paid, it was captured. So then I wouldn't want to show this. I wouldn't want to show the 10,000, but I would want to show the drawings. Okay, let's see what they've got in the answer. Okay. All right, sales. Sales is fine. Cost of sales. Cost of sales. What's wrong with the cost of sales? Oh, probably the discount here. Okay, discount received. Who do you receive discounts from?
Creditors.
Correct. Okay, so they've put it here. Right, the purchases is updated. Okay, so they've just taken it off the purchases. We've shown it separately. Okay. Right, I did mention that earlier, which was a consideration. So UNISA tends to put everything under cost of sales, okay, instead of splitting it and showing it separately. Right, so do it the way that they've done it in their workings, because chances are they're probably going to have that in their solution. All right, so just remember to take off the discount received from the purchases, okay, because it affects your creditors. All right, and then you've got the closing stock, that's fine. Okay, the admin expenses, yeah, that's fine. See, they have to disclose it. You have to update it because remember, it belongs to drawings, not admin. That's fine. Credit losses, that's fine. Depreciation. Why don't they show depreciation here? That's bad. Let's go back to the question. Okay, additional information. Depreciation amounted to 940 on furniture and fittings and 3,000 on motor vehicles. Okay, is this additional depreciation or is this depreciation that they've already captured? Okay, the question's vague. Do you see that?
Yeah, because I would also put it under
Yeah, I would have shown more
expenses.
depreciation because that's what they're saying. They're saying additional information. Additional means more information, right? So if it's more information, I
Ooh,
would
no, it's
say there's more
already.
depreciation.
I think they accounted for it because if you go,
Yeah, according to their answer, they haven't included more depreciation because they've just
I
kept it
think
as 3940. But then that's not
yes,
correct. They should have been more specific. They should have said depreciation was already accounted for.
but I think these aren't adjustments. This is just additional information.
Fair enough, but additional information could also pertain to an adjustment because these were things we had to provide for. That was an adjustment.
That's true.
Yeah, so it's a bit vague. They need to be more
Yeah,
specific, but as long as you're correctly processing it, there's nothing wrong with this. I'm not going to change it. Okay, assuming this was additional information, this information needs to be catered for. All right, so you wouldn't do nothing, you would have to do something. If I got that
yes,
in an exam, I would process depreciation. I wouldn't show nothing because showing nothing means you didn't do anything with that information.
yes. I know
Okay,
what you're
so
saying.
rather show it than don't show it. This is telling me that I need to show depreciation and I need to show the accumulated. I've done that. I'm not going to change that. Okay, I'm going to leave it as is.
Okay.
All right, so obviously we'll have a different total because of that depreciation. Okay, but it's just because of the question. That was why. All right, let's check our SOCI. Okay, the SOCI has... Okay, so the SOCI has capital, that's fine. All right, the balances are fine. The salaries is fine. Okay, that's fine. Okay, the drawings. Okay, see, have a look at their working. They also included the 6,000, the 4,000, so you do have to include it, so that's fine. Okay, so we've included that. 6 and 4, that's perfect, and we've taken it off the drawings, off the current. Okay, we've minused it from the current, that's fine. Okay, and then okay, the total will be different because of the profit. Obviously, because I've taken that drawings into consideration, they haven't. All right, so my profit figure is different to theirs. So obviously I'll get a different appropriation, but the process is correct. Okay, you apportion it 2/3 to T, 1/3 to P. Okay, I'm not going to change any of that because I'm going to leave the profit as the profit. That figure I'm going to keep as is because we did process more depreciation. Does it make sense? Are you still following? Are you still
Why?
there?
Yeah, I am. But why is their income so much higher?
The income is higher because they didn't take out the depreciation. Look, if I delete this,
Yeah, yeah, yeah.
if I delete this, delete, delete. There, same answer.
Okay.
22480.
Okay, 22480.
Do you see it?
I do.
Okay, it's because they didn't process more depreciation. We did, because it was additional information. They told us there's depreciation, so you process depreciation. So that's what you do. You process depreciation. Right, so if we process more depreciation, obviously our profit will decrease. Okay, I'm not going to change this working. This working is perfect. Okay, if they give you additional information, you have to process the depreciation unless they explicitly say in the question that it has already been accounted for. I didn't see that in their question. I'm not going to take it out. Okay, if I was them, I would have said here as an additional note, to make it correct, I would have said this depreciation was already accounted for. Right, if they said that in the question, then I wouldn't have done anything. Does that make sense?
Okay.
Okay, if they told you that in the question, and then I would draw up exactly what they've got. Okay, then their solution would be correct, because then you wouldn't have shown more depreciation.
Okay.
Okay. All right, so
Yes.
don't worry about these workings. Okay, remember, these are workings that we're looking at. So I've looked at it with you and we've done it correctly. Okay, if this was an exam paper and they gave you depreciation and it said depreciation amounted to 940 for furniture and fittings and 3,000 for motor vehicles, would you have accounted for that in the exam? Yes, you would. Okay, and then you would have shown exactly what we've shown here. Okay, had the question said depreciation amounted to 940 and 3,000, and they said the depreciation was already accounted for, then you would not have shown anything, and then you would have shown this. Does that make sense?
Okay. Yes.
Okay, all right, it doesn't matter what they give you here because these are just examples and they've already given you the answer. All right, so when I look at their solution, I can tell you that they haven't shown it because it's not in their solution. So then I can tell you that they have assumed that this was already accounted for. Then they wouldn't have done anything in an adjustment.
Okay.
Okay, is that clear? Does that make sense?
Yeah, I get what you're saying.
All right, so just go through it normally. Okay, we're doing it like how we would do it in an exam. Okay, we go through everything, we check everything, we read it as is, and then we look at it. And then afterwards we check their solution and see, do we agree with the solution or don't we? Okay, here I won't agree with them because I would have wanted them to tell me more in the question. Tell me that you've already recorded this. Don't make me guess whether you have included or you haven't included, and whether I should include or whether I shouldn't. Does that make sense?
Yeah.
Okay. All right. So I would suggest they improve this. Right. They should tell the students that this is already accounted for. Okay. Don't guess. Okay. Guessing is bad. Okay. This is vague. It's not specific. Right. Tell us exactly what happened. If they did process it, then tell us they processed it and then just don't give us this option. Don't give us number 5. Leave it out. Right, don't include it if you don't have to adjust for it. Does that make sense?
Yeah.
Yeah. Okay, so just be careful with things like that. What I'm more interested in is this. Does it balance? Okay, so whether you did process more depreciation or whether you didn't, as long as it balances, it's correct. Okay, because if it balances, you've accounted for the depreciation in the income statement and you've adjusted your statement of changes in equity and you've referenced it correctly here and you've updated your your non-current assets for the depreciation.
Okay.
Okay, so when I don't get it to balance, then I need to go back and look for things that I need to adjust and correct. Okay, so I did do that for the bank, okay, because that was the payment. Right, that was something we had to look at because we saw the payment in the question, but they didn't talk about the payment in the balances. There was no payment mentioned. Okay, because that's an adjustment that we had to adjust for. That was number 2. They told us they agreed to pay the partners the following, and then if you're agreeing to pay the partners, then you would debit the drawings and credit the bank.
Okay.
Okay. All right, let's look at another one. Right, were your workings in line with what we had done?
Yes. You said I must just do the workings for...
Yeah, so workings as in, did you know where to adjust what?
Yes.
Okay,
Yes.
good. That's what we're looking at.
But the debits and credits.
Yes, correct. Right, because those workings give you the right adjustments, and then we can do the adjustments obviously now when we're looking at the question. Okay. All right, let's look at another one. Okay,
Can we just go through the equity, and they didn't do it the way we did it for 3.3.
Equity here. Equity, capital, and current. Right, so they've only shown capital and current because they closed drawings off to current.
Okay.
Have a look. There is no drawings here in the associate. Why? Because they closed off the drawings to the current account.
Okay, because they also, for the bank overdraft, they didn't add the 10,000. I don't know if you've noticed.
The bank overdraft, they left it as 4,922 because they assumed it was paid from the drawings. They've taken out of drawings. That's what they've done. They've taken it out of drawings and they've closed it off to drawings because there's the +6.
Okay. All right. I get you.
Okay. So for ours, we said it was paid, okay, but that was captured incorrectly and we had to adjust for the payments.
Okay.
Okay, so if you look at this, again, maybe they could have been more specific here. Okay, was this captured or wasn't it? If it wasn't captured, in other words, if they didn't show the payments, okay, then they have to show the payments. Right, if they assume they did show the payment, then they wouldn't show the payments. Right, so what did we do? We showed it as though they didn't capture the drawings. Okay, they have to show it. Right, so we said that the salaries is something that they have to record because they're entitled to it. Then we said they had to pay the salaries and wages. So if I pay the salaries and wages, I do have to affect bank negatively. I have to credit the bank. Right, and then when I credit the bank, I have to show the bank overdraft increasing because I'm paying. So I'm assuming that they didn't record it in the books of the business. There's the notes.
Okay.
Okay, pay to the partners. All right, that's what we've said. Right, it's obviously not in their solution because they haven't assumed it wasn't paid. Okay, they assumed it was paid, so they didn't show it. We assumed it wasn't paid, and that's why we have to show it. Okay, it's two different ways of looking at it. Okay, this method. Okay, so do you understand what method we've used? We've accounted for the payment as though this was additional information that wasn't accounted for. Not accounted for. That's what I did for all of these. For all of them, I did that. Okay, so again, if you're looking at their solution, you can actually copy paste this. All right, for their solution, you would just put that, and then you would say, that's what you would do. Right, if you're looking at their solution. Right, if you're looking at their solution, you would have said it was already accounted for. because that's what they're showing in their records. In their records, they don't show minus 10,000 because they assumed it was already accounted for. Are you with me? Are we on the same page?
Yeah, I get what you're saying.
Okay, so if you assume what they've assumed, so assume point number 2 was already accounted for. So in other words, basically eliminate it and only put the disclosure. Both amounts were recorded as admin expenses. Okay, then you would have to adjust your admin. There's the adjustment for admin, and then you'd have to show the drawings. That's all, because that's disclosure. Right, you're subtracting it from admin and you're showing it under drawings. Does that make sense?
You move drawings. Yes.
Okay. If you assume, so delete this and delete this. Okay, if you assume that they haven't recorded anything, and these are adjustments, then you have then your solution will look the same as mine. It'll look exactly like this.
Yes.
Okay, because we have to correct the disclosure for the admin expenses. We have to show the salaries and wages and show the payment separately. When I show the payment separately, I then have to update my bank. Okay.
Okay.
Right, if you want to show the disclosure where you don't show the drawings on the face, then you've got to close this off. Right, then if you close off drawings, then you wouldn't show these two columns. Okay, and then you would show minus here, minus there. Okay, and you would say close off drawings to current accounts. Right, and then those totals will update, and then you will fix the disclosure on the face. Right, because the disclosure will be different now, obviously, because you don't have the drawings.
I just wanted to know, if you go up to your SOC, when you paid salaries as wages, paid salaries as drawings,
What about it?
why is it negative?
Because you're taking it out of the current account because it's drawings.
Because
See,
it's basically like you paid salaries on the top, which is positive, and then it's like you took it away.
Because it's paid, it's going to affect the current account because I'm taking it out of drawings. Because it's drawings. Drawings, debit drawings. Okay, credit bank. So I'm paying it. I'm showing the payment. I'm showing the amount that's being removed from the drawings. Because I'm paying the salaries and
So basically, it's like they.
Because remember, this is their entitlement. This they have to show. So what happens?
Yes.
What happens when you give someone a salary? You debit the salaries and you credit the
Bank.
current accounts.
Oh.
What do you do when you pay them? When you pay out the salaries, you've got to credit the bank and debit the current accounts if you're paying it out. So this is their entitlement. They're entitled to a salary. This is showing the payment. They're taking the salary. They're taking the salary in the form of drawings.
Okay. Okay.
Okay, this is what you state up front when you're giving them that salary. Whether they draw the salary or not, if they didn't get paid the salary, delete. That wouldn't apply.
Okay.
Okay, only
Isn't they just
because they
keeping it
said
in
in
the
the
account?
question it was paid to them. If it's paid to them, you have to show that because their entitlement will decrease. Notice their entitlement is now lower
Yes.
because their drawings has gone up.
Okay, I get it.
Okay,
I get what you're
if
saying.
they said this wasn't paid, then delete it. Then that tells me that they earned a salary of 6 and 4 and they're entitled to more. Whether they want it or not, it's up to them.
Okay.
Okay, if they want it, then they must pay it out. And if they pay it out, you're going to show more drawings and less current accounts.
Okay. All right. I get that.
Okay, because it's a payment, it's a movement of cash. Right, this is just an entitlement. Other way around. Yes, okay. This is their entitlement. They're entitled to salaries. They're entitled to interest on capital. Whether they take it or not, it's their own decision.
Okay.
Okay, when they take it, then you will have drawings. Because drawings indicates an amount that was paid out to the owner. Are we right?
Okay. So,
Yeah, it's a good
so it's a
question.
trading account.
Pardon?
So I get what you're saying.
Sorry, say
So
that
the
again?
current account is the current account is like
It's
a
short-term
trading,
capital.
like
Short-term
yeah.
entitlements. Yeah, it's
Okay.
exactly what we described it last week in the notes. Okay, current account is looking at the attributable amount to the partner based on the operations from the partnership. Everything here is partner specific in terms of operations. This is capital they would have given when the partnership started.
Yes.
Okay, so capital is capital. Current account is also capital as long as it's a credit balance. If it's a debit balance, it's actually a drawings type figure. All right, and that was what I was
Okay.
trying to explain last week when we were looking at theory. All right, once you've got the theory, then it's quite simple. All right, and because you're asking those questions, I can see it's making sense now. The
Yeah.
dots are joining now because now you can
Yes.
appreciate
Yes.
that those amounts here represent what the owner is entitled to. That's their entitlement.
Yes.
Okay.
Okay.
And that's very important to note because when we look at a change in ownership, we're going to look at the exact same things again. And now, because you've got that understanding now, it'll be easier to understand later because you can appreciate that this is the equity.
Yes.
Okay,
Yes.
good.
Okay.
Yeah,
I
you're
get
on the
it
right
now.
track.
I get what you're saying.
You're on the right track. That's perfect. If you've realized that, that's brilliant. That's good.
Okay.
Okay, so just remember that this is equity, but it's equity looking at different things: long-term equity, short-term equity, and drawings that affects equity. The
Yes.
profit, the appropriation will also be part of equity because it's going to affect their entitlement, their short-term current accounts.
Okay.
Okay. Are we okay with this one? Can we look at the next one?
We can.
Okay, great. Okay, again, just disclosure-wise, I'm just taking what we had here. We'll update and change if we need to. All right, this is the templates. Okay, every question in terms of disclosure for partnerships will always look like this. Okay, you'll have columns for different things. Those ones you will probably have. You might have others, depending. Okay, delete the profit sharing. Delete that, delete that. Perfect. There we go. Okay, again, blank template. This is how you do every question. All past papers, all assignments, it doesn't matter what. You always have to have a template to start with. Okay, then you need to go to the question and you need to pull all the right figures. Okay, you tell me where to put what. Okay, because you would have done the workings, but you wouldn't have done the disclosure. Right, so you can do it with
Yes.
me. Okay, let's put in the names
so
here. This is going to be for, okay, shoe
shoe
and string.
and string.
Okay, go for it. Tell me what to do.
Okay, so land and building, asset, financial position,
Good.
100,000. And then vehicle also non-current asset, financial position, 99,000. Then trade receivables, current asset, 82,000. Inventory. Okay, wait, so this is at the end, 28 Feb.
Look at the required. The required says 28 Feb 2015. Yeah, so this is closing stock.
Yes. So this is closing.
Where does closing stock get disclosed?
Comprehensive income.
No. Well, yes, because it's a working, if it's perpetual. Do you know, periodic. Do you know if it's periodic? Now, you don't know. But it must go here, right?
Yes, inventory and current assets.
Yeah, it must go there because that's the closing stock.
It's 135,000. Yes. Okay. But then, okay, so but it would also go under your cost of sales as a closing.
If it's periodic, do
Closing
you know if it's
inventory.
periodic? I don't see any purchases.
Okay.
Okay, I don't see it. I don't see any purchases, so I'm not going to worry about that.
Okay. Bank current asset 98,000. Accumulated depreciation would be a negative asset, so we'd minus it. 49,000 from vehicles.
Good.
Allowance for credit loss would also be a negative asset, so 1,000. So we'd minus it from trade receivables.
Yes.
Capital, so that would be SOCI.
Yes.
So for shoe, there's whatever is 240,000.
Yes. Just be careful. This is 240, but because of the date, I'm going to show that at the bottom here because it's the end of the year.
Yes. Okay. And then string is 160,000. Current accounts, this would be at the beginning of the year.
Yes. Why? Because of the date.
So credit for shoe is a positive, so that would be 50,000. And string would be negative 40,000.
Correct.
Okay, drawings for shoe is 55,000. And drawings for string is 11,000.
Yeah, at the end of the year again because they didn't give us the date and it was at year end. Good.
Okay, and then admin expenses, statement of comprehensive income would be 80,000. Trading account gross profit for the year, okay, would be 200,000.
Yeah, so they didn't give you anything for sales and cost of sales, so you can ignore those two lines. And you can just start with gross profits. All right, good.
200,000, okay.
Adjustments. What do you do with this?
Okay, so then the partnership. Interest is to be calculated at 7.5. I would actually do it the other way around. I would try and do the adjustments first before I go through partnerships.
It's up to you, as long as you cover all the points. So if you want to do it that way, let's start here then.
Okay. Okay, so depreciation on motor vehicles at 30% per annum according to diminishing. Okay, for vehicles. So that times 30%.
Good. Disclosed where? Here, hey?
Yes. So.
Agree with that?
I do.
Okay, and then that will also be disclosed where? Here.
By there. Yes. Financial position.
Yes. Okay, because remember, debit, depreciation, credit, the accumulated. All right, happy with that one.
Yes.
Next.
Okay, credit losses, 2,000. So I would debit credit losses. So expenses would increase. And I'd credit my debtors. So I'd minus 2,000 from debtors.
Yes. Next.
Interest on drawings for the current financial year amounted to 5,000 for S shoe and 1,000 for S string. Okay, so that's SOCI.
Yes. Okay, notice you have a new line here.
Yes.
Interest on drawings.
So,
Where would you put it? What is interest on drawings going to do to the partnership? Think about
it's going
that.
to add to the partnership,
Yes, it'll add to the partnership. So which column
but
do
it
you
would
show
take
that?
away appropriation.
Good. See, your understanding is already there. Okay, so you're going to have to include 6,000 here as a benefit for the partnership because the individual
Yes.
partners must pay interest on their drawings.
Yes.
Okay, what am I going to do with the 5 and the 6? The 5 and the 1?
I would take it out from current account.
Correct. Okay,
Okay.
5 4, shoe,
Shoe,
1 4,
string.
string. Good. Okay, next.
An investigation indicated that credit losses could be as much as 4,000 during the next financial period. Okay, so we have to. What was our allowance for credit loss?
I don't think there was one. Was there one?
There was 1,000. Oh,
Let's
so we'd
double
have to
check. Oh,
add
yeah, there was. Yeah,
3,000.
you're right. Correct. Yes, agree.
So I would debit credit losses
Why?
because our expense would increase.
Good. How much are you going to debit it by?
Plus 3,000.
Good. How did you get 3?
The 4 minus 1.
Yes. Good.
And then allowance for credit losses is going to increase. So I would add that by 3,000.
Correct. Okay, the allowance is 1, hey?
Yes.
So we need to show this in brackets.
Okay.
Okay, great.
And now back to the partnership.
Yes.
Okay. The partnership stipulates the following. Interest is to be calculated at 7.5% per annum on the opening balances of the capital accounts. Okay. So interest on capital, I'd say, okay, so for Shu, what was her amount?
240, 160. Okay, remember those amounts won't change because they didn't talk about
so 200.
a change in the balances, yeah. So what they had at the beginning will be the same as what they had at the end.
Yes. So 240,000 times 7.5. And the same for things, so 160,000 times, and then I'd minus it from the partnership. So minus 30,000.
Good, I agree with that.
Okay.
What else? Next.
Interest is to be calculated at 10% per annum on the opening balance of the current accounts.
Okay, something different. Interest on current accounts.
Why would you get interest on current accounts?
Because remember, the current account is representing their entitlement or what they owe the business. So if you look at shoe and string, remember this is something that you would negotiate as part of the agreement before you sign the contract. Right, so shoe and string are saying if there are balances on their current account, which is their short-term entitlement, shoe has a benefit that they have to derive from the partnership and string hasn't. String has been an irresponsible partner because they've taken more from the partnership. Right, so if they've taken more from the partnership, they must pay the partnership back more. If they have more invested in the partnership, they should be entitled to more benefits.
Okay, I get what you're saying.
Okay, so it's just something part of the terms and conditions. This is as per the partnership agreement, see? Okay, they've stipulated these terms and conditions when they created the partnership.
Okay.
Okay, so they're just carrying out what they've agreed.
Okay, so shoe's interest would be 50,000 times 10%.
Positive or negative?
Positive.
Good. Okay, that'll increase shoe's entitlement. Good.
And then strings would be negative.
Yes. 10. Okay, and then what are you going to do with the difference?
So appropriation 1,000.
Good. What is the
Because if they take it out,
5,000 going to do to appropriation?
it's going to minus. It's going to come out from the partnership, so it's going to minus.
And what is the 4 going to do to the partnership?
It's going to add to
Correct.
it.
Okay, yes. I agree with everything so far. It's good, looking good, yeah. Okay, your thought process is correct. That's important. Next.
Okay. S string is entitled to a monthly salary of 1,250. So it's only string, S string, 1250.
Which column? Which column? Which column does this go to?
Oh, sorry, current.
Yes. Okay, so remember, salaries increase the entitlements. String will be entitled to more.
1250. Yes.
No, 1250 times 12.
Oh.
It says monthly salary.
Okay. I see that.
Okay, it says monthly salary.
Yes.
Okay, next.
You take it out of appropriation.
Good. Because the partnership is going to have to, inverted commas, pay for it. Does it make sense?
Yes.
Okay. Profits and loss are shared equally. That's nice. So 50-50. And we've looked at the question. All we have to do now, wrap up. Okay. So this I'll do for you. You've done the hard parts. Okay. You've had to adjust everything, provide for the partnership transactions, and now we can calculate. All right, other expenses, sum up. Okay, profit, this minus that. All right, that profit is attributable to who? The partners. So it goes to appropriation here. Partnership, profit, appropriation, same figure, reference it, whatever it is. Okay, then you need to appropriate the profit. Is there a profit left over? Yes, there will be. What is the profit going to be? Let's sum up. Okay, 60,000 is going to be apportioned. How much does each partner get? 50-50. Do you agree?
Yes.
Okay, so 30K for each partner. Okay, what else do we have here? Okay, total collar, I'm not going to total up. You don't have to. You can if you want to, but I'm not going to add up. These are the important columns. Okay, so this is what I started with. That's what I ended with. Okay, there weren't any additional drawings. If there was, the question would have stated it. Okay, and then you need to add up that. And then you need to add up this. Okay, always double check if you've done it correctly by adding up this last column. You should get 0. And you do. Okay, well done. All right, so now take this and disclose that on the face of the statement. Right, in an exam paper, they're never ever going to give you all 3. Right, they'll give you one of these for a particular question. So you never have to, you're never going to have to reference elsewhere. So for example, if you get stuff wrong here, obviously you're going to get it wrong here. So they don't do it that way. Okay, examiners test questions separately. And that's the nice thing about it. So if you do make mistakes in one question, it won't affect the other question.
Okay.
All right, because think about this. Let's assume you made a mistake with the credit losses. The profit will be wrong, then this whole thing will be wrong, and then so will this. Does that make sense?
Yes.
Yeah, so UNISA is going to give you extracts of different statements. And that's why it's so important to go through these activities, because it kind of hones your skills in terms of what you're dealing with. If I'm dealing with income and expenses, I'm only thinking about that. If I'm dealing with equity, I'm only thinking about that. If I'm dealing with financial position, then I'm thinking about this. Okay, does that make sense?
Yes.
Okay, yeah, so that's exam technique, and that we'll practice when we look at past papers. All right, let's work out these figures. Ooh, it didn't add. Oh, equal sign. Okay, furniture and fittings, not applicable to this question. Okay, assets and liabilities obviously need to equal to the total assets. Okay, assets here, 444. Okay, next. Capital, reference it, sum. Sum up my capital. Here's my capital. Both partners. Okay, reference the current. Both partners. Okay, reference the drawings. Right, total equity, sum up the total there. Okay, all right, liabilities. Oh, we had nothing. Yeah, we had nothing. Okay, yeah, so it does add up. The equity is the same as the assets, 0 liabilities. No non-current liabilities, no current liabilities. Okay, that was a very easy question. All right, you didn't have any adjustments here at the bottom. Okay, is that in line with the textbook? Let's check. Let's make sure. Okay, 3.3. Okay, yeah, look how short that is. They didn't even show much disclosure. 100,000, yes, that's right. Okay, good. Happy with their workings. Let's check. Appropriation, does it look the same? Okay, notice they've obviously closed off the drawings. Okay, they tend to close off drawings to the individual column. Right, so all they've done is they've just looked at what we've done here in this column, and they've just closed it off to that one. So they've just reduced the current account. I prefer keeping it separate, but it's up to you. Okay, you can do it like them. I would do it like this if it was disclosed on the face. Okay, because if it's on the face, then this is the details. Okay, the details is in the inverted commas the note. This is kind of like a note, right? And then obviously on the face of the financial position, you can just show the summary, capital and current. Okay, so obviously they've taken it out. They've minus the 55. Let's see if it's correct. This minus the 55, 43, yeah, it's right. Okay, and then the 12 minus the 11 is the?
It's 1.
1, yeah, it's right. Yeah, it's correct. It's perfect. Okay, so yeah, no issues with the answer here. Everything's perfect. Looks fine. Everything looks okay. Yeah. Great. Ooh, forgot about the financial position. Where's the disclosure? Oh, they didn't even disclose it.
They didn't do it, given. Yeah.
Okay, yeah, not given in this question, but you've got it. Okay, it would look like what we've done. Okay, how are we feeling now about disclosure for partnerships? It's quite easy, hey?
Yeah, it's not that bad.
Yeah, as long as you get the theory correct. And the hardest part about disclosure for partnerships is this. This is something that you need to NB. Okay, be careful. Okay, note the theory and how it applies. Right, so in all questions, just remember, partners are separate from the business and they are individuals. So each and every partner needs to be accounted for separately in their own separate disclosure statement. Okay, statement of changes in equity. That's why you have all these columns here. Right, that's the only difference really from a partnership perspective compared to sole proprietors. Okay, happy?
Yes.
Great. Okay, so let's save that. All right, we've got a new section coming up. I think that's the end. Yeah, I saw it was the end here, and then chapter 4. Okay, changes in ownership. Okay, let's cover the theory, and then we can look at some examples. Let me get my notes again. Let's go open up note number. It'll be 3, I think.
Yes.
Changes in ownership. This one. Okay, so let's cover the theory. So you've got the theory. Okay, some basics from before. What do you think happens if a partnership fails? Will it continue?
No.
Why not?
The partnership fails.
Will it continue? You said no, it won't. Why not?
Because it's not working out. Or
No.
The company can't survive.
Why not? Why can't the partnership continue?
Maybe there's not enough profit.
Okay, you're thinking it from a very literal sense, but if you're thinking about it
Oh,
from an accounting point of view, can a partnership continue if a partner leaves?
like are you talking about like maybe somebody dies?
Yes, if somebody dies, that's even the worst case scenario. Okay, I wasn't thinking about that,
Oh,
but
okay,
if
yeah.
someone died, so
Okay.
if they died, then what would happen?
It will fail. It has to stop or
Correct. The partnership would dissolve, right? And why
dissolve. There
was
we are.
will it dissolve? Because is it a separate legal entity?
No.
Correct. Okay, so this is theory. This is to remind you that a partnership is not a separate legal entity, and this is to remind you that when you have a change in ownership, okay, you have to treat them like sole proprietors. What belongs to A and what belongs to B? Right? And that's why when a partnership fails or ends, okay, or if somebody had to die, all right, what do you have to do? You have to value the company. You need to, well, the wrong choice of words. You need to value the business. Okay, it's not a company, right? It's a
Okay.
partnership. Okay, so when the partnership changes, and it can be a change because of all sorts of reasons. What happens if C comes into the picture? Okay, will A and B's partnership stay the same?
No.
No. Will A and B's partnership continue?
Yes, it will, but the terms would be different.
Okay, that's the wrong answer. Okay, A and B's partnership will end. Okay, and then A, B, and C will have to start over. New partnership. Okay, do you see the difference?
Okay.
All right, so every time you have a change in ownership, it doesn't matter, okay, for whatever the reason is. If somebody dies or retires or leaves, or if somebody enters the partnership, okay, a new partnership will always start. All right, the old one will always die, inverted commas, or dissolve, okay, and a new one will start. Okay, so when I do these workings here, you always have to look at old and you have to look at new. That's how I do changes in ownership. All right, keep it simple. The old means the one that's going to end. The new means
Okay.
from this point onwards. Okay, so if you and I are in a partnership and we bring in a new partner, okay, we have to sign a new agreement. The old agreement is null and void. Right, the law won't view that agreement as being binding, okay, if you bring in a new partner. Okay, because it's a business. The business is going to run normally, but with three individuals running the business instead of two. Okay, and what happens now if we bring in D? Now we're expanding the partnership. Okay, and lawyers, doctors, accountants, those type of people do these things. Okay, they sign agreements because they bring in new partners. Okay, you might be a specialist in some sort of law. Okay, and then somebody else is a specialist in a different type of law. And now they bring in another partner so they can cater for more clients, that type of thing. Okay, and that's the theory that you'll get from the textbook when you look at the background. Okay, so as long as you're comfortable with that, and as long as you understand that with a change in ownership, you have to value the partnership the moment it changes. And that moment is an event that needs to take place where you have the old, okay, and then moment in time, and then you have the new. Right? And that's how you need to approach it. So, what are you going to have to do? Well, value needs to be established. So, what are we going to value? Do you know?
Assets and liability.
Very good. Yes. Okay. You value all the inverted commas possessions of the business. All right. So when you look at, I think I might have written it down. Yeah, I did. There. Okay. Value should be used. Okay. Fair value. Why fair value? It's
Okay.
because it's now. Right. When the partnership changes.
Just clarification, fair value and market value are the same thing.
Yes, but they're slightly different because fair value means it's like an exchange. Okay, there's going to be an exchange. So if you want to get very technical, right, they are different to some extent, but they're similar in terms of context. Right, when you talk about fair
Okay.
value and market value, you're talking about what the asset is actually worth today. Right, fair
Okay.
value would be someone's estimate. Right, so you believe, okay, the asset to be worth, let's say, 100,000. Okay, but market value is what somebody's actually willing to pay for it. And then there needs to be a willing buyer
Okay.
and seller.
All right.
Okay, so it's a little bit different, and in I and V they take it a step further. Okay, there you have to make that distinction because there's lots of different types of value there, right? And it's all about finding value, right? So fair value is your estimate of what you believe your asset is worth. Market value is what the market believes your asset is worth, and sometimes they're the same, sometimes they're different, right? From an accounting point of view, fair value and market value would be the same.
Okay.
Okay, but it's important to understand when you're doing this. So, when do you actually value these assets? When the partnership changes. Why? Because you have an event. Right, so think about this. Let's assume A and B start a partnership, and this started back in the 2000, in turn of the century, okay? Or the millennium, actually. Okay, 2000, right? That's when they started the partnership. What happens now, 20 years later, and A and B want to bring in C? Those assets that you had in the 2000, okay, are they still going to be worth the same today?
No.
Probably not. Okay, so those assets and liabilities have to be valued. And we need to determine this owner's equity at that point in time. Right, so do you agree if A and B have been conducting business since 2000 and they are now going to bring in a partner in 2020? Surely all the benefit that was derived from 2000 to 2020 should belong to A and B and not to C. Does that make sense?
Yes.
Okay, because they earned it. They put in the work over 20 years. It's their partnership. They derive the benefits of that partnership. And that's why you have to work out the value, right? And you do that using a valuation statement. Not statement, a T account, valuation T account. Right, and you'll see that on one of the slides. Okay, it's coming up. Right, so when you do a valuation, okay, are partners entitled to the valuation adjustments? What do you think? Who's entitled to the valuation adjustments?
Hello. Hello.
Who's entitled to the valuation adjustments? Cheryl, are you still there? I think the connection was a bit bad there.
Yeah, you broke up just a little bit.
Yeah, sorry about that. I think my connection's not so great this week. I'm not too sure. Yeah, I'm getting that message popping up. So it is my side, it's not your side. Okay, but yeah, if you can hear me now, the
I
question
can hear
was,
you now. You were just saying
yeah, the
valuation
question was,
adjustments.
are the partners entitled to the valuation adjustments?
Yes.
Good. Okay, so they are entitled to the good and the bad. Right, so if you
Yes.
have a building and that building
Mm-hmm.
is impaired, okay, the value of the building has depreciated. Well, depreciate is not the right word, impaired is the right word. Okay, you lower the value of the
Okay.
asset. Okay, or if the vehicle loses value, okay,
Mm-hmm.
those assets belong to the partners. If the building increases in value, okay, they also are entitled to that benefit. Right, so have a look at the workings here. Okay, valuation of assets. How do you increase the value of an asset? That you should know.
Debited. You
Exactly.
debited.
Okay, so when you debit the asset, what would you credit? Well, forget about this whole valuation. Just think about this for a minute. Okay, if you increase the value of an asset, you'll debit it. Do you agree?
Yes.
Okay, so you have to credit something. What are you going to credit? You're going to credit the capital account, right? And you'll credit the capital
Yes.
account for A and B because who owns the assets?
The partner
Exactly.
or
Okay,
partners.
the partners own the asset. So any benefit goes to
Yes.
their capital accounts. Right, notice you have this, which is a working account. Okay, that working account is only relevant when you're processing the change in ownership. Okay, so you'll only ever have it when you're looking at a change in ownership. You'll never, ever, ever have a valuation account in any other situation. Only when you have a change in
Okay.
ownership.
Because I was just about to ask the difference between valuation and depreciation.
Okay, depreciation is an account that you will record in the books of the business. Because depreciation
Okay.
is something that has to be recorded. Valuation is something that only exists when you have a change in ownership.
Okay.
Okay, so just remember it's an adjustment. An adjustment means to change the records to fairly and reliably represent the information for the users of that information.
Okay.
Okay, so when is this going to happen? Only when the partnership changes. If I bring in if I bring in someone new, I have to value the partnership. If somebody retires or leaves, I need to value the partnership. Okay, if one partner dies, I need to value the partnership. Okay,
Okay.
if anything happens, any change whatsoever, we need to value the partnership. Right, so there's a question here. Okay, why is it transferred to the capital account? Any idea?
No, you said I know is it's because of the partners invested.
Yes, it's long term. Good. Okay, it's not going to go to current account, it's going to go to capital because capital is looking at what they invested in the business when they had invested. So if we go back to this example, in 2000, A and B could have invested 100,000 each. That 100,000 in 2000 could be a million or more this year, in 2020. Okay, do you see it? It
Yes.
changes. So now in the
Yes.
partnership, are you still going to see 100,000? Yes, because that's the capital.
Yes.
Okay, but their current account could be huge because it's grown so much over time. All right, so that
Yeah, I
initial
get what you're saying.
investment is always going to be recorded as their capital contribution. Right, if the partnership changes, then you need to consider the long term entitlements. Does that make sense?
Can you please say that again?
If we're looking at a change in ownership, we need to look at the long term entitlements because that
Okay.
belongs to the partners.
All right.
Okay, perfect. All right, this is an example that actually comes out of the textbook. Okay, remember you might have a slightly newer version of it, so it might still be there or it might have been changed or altered in some way. Okay, but I'm just going to discuss it because the workings are all here. You don't even have to look at the textbook. Okay, you just have to look at the diagram. Right, so if you look at the diagram, okay, you have a partnership, and that partnership has land and buildings and debtors. Okay, when the partnership changes, and it could have been changed for whatever reason, maybe someone else is coming into the business, maybe somebody's leaving, it doesn't matter. Okay, but there's a change. Right, so what do you do when you have a change in ownership? We said we have to value the assets and the liabilities of the business. Right, so the
Okay.
first thing that we need to look at is land and buildings. Okay, the land and buildings are valued at 12,000 more than the cost, okay, or more than its recorded value. Right, is that a good or bad thing?
It's a good thing.
It's a good thing. Right, so what are you debiting here? You're debiting the land and buildings. And what are you going to credit? You're going to credit the valuation. Okay, notice you're crediting the valuation because the valuation needs to be split between A and B. Okay, that's why a valuation is similar to a profit and loss, similar to an appropriation, similar to...
Okay, so it's a working account.
Exactly, yes, it's a working account. All right, so the reason why I've got this block in the middle is because it actually works itself out. Right, you never ever have the valuation accounts. Okay, and then look at this. Okay, assume the debtors have an allowance of 5,200. Okay, what do I have to do? I have to credit the allowance because an allowance is a negative asset, and those are basics. The basic principles always apply here. Assets increase on the debit, that's why land and buildings went up on the debit. Okay, allowance for credit loss is a negative asset, so it'll have a credit balance. Right, when you credit this account, you have to debit the valuation. Okay, so when you look at these examples, if you go through textbook examples, they'll give you either a T account that'll look like that, valuation, or they'll give you journal entries.
The only question I have is, why don't we close off the land and building account?
You can't close the land and buildings because you're not selling it. Okay, you can't take out the land and buildings because if you close it off, that means you've disposed of that asset. You're not disposing of any assets. You're just valuing the assets so that you can bring in a new partner or you can adjust the business's records. Does that make sense?
Okay, yeah, because I'm just thinking about it because with all the other working accounts, we always closed off.
Okay, you're thinking about closing off accounts because it's the end of the year. But you can close off these accounts, but you only close off the accounts when you liquidate the business. And that's a separate chapter. Okay, liquidations do get covered, but not now.
Okay.
Okay, but yeah, you're right. You would have to do this, but not for a change in ownership, for a liquidation. In a liquidation, you close off the accounts.
Okay.
Okay, maybe you recall a little bit of the assignment. Okay, in the assignment, I had done a liquidation because you had to close off accounts. Yeah, but we'll get there. We can look at it. We can always go back to it. Yeah.
Because we're not, okay, so for valuations, we're not selling it. So that's why we're not closing it off. Okay.
No, a valuation is just determining equity, remember?
Yes.
Okay, A and B, bringing in C. What do we need to establish? A and B's owner's equity. We need to value assets and liabilities for A and B prior to C joining the partnership. Are you okay?
Yes.
Okay, good.
I get what you're saying.
All right, perfect. Right, and then ultimately, who's going to get the benefits? Well, the positives. Okay, well, you'll debit the valuation and then you will credit the capital account. Right, so all I'm doing on this diagram is giving you a visual interpretation of what I've got on this slide. Okay, this slide is showing you the increasing and decreasing of assets and liabilities. Okay, and this is showing an example of how the valuation account works itself out. Okay, because if you add 12 here, you're going to minus 12 there. But it's going to go to A and it's going to go to B. Right, so 8 might go to A, 4 might go to B. But the point is, you're still going to eliminate it. This will eliminate. Okay, are you happy with that?
Okay.
All right, so just appreciate...
Yeah, I get what you're saying.
The diagram is available. It's just to show this working out. Right, this debit is going to eliminate that credit. This credit is going to eliminate that debit. This debit is going to eliminate that credit. Right, the most important thing to remember is this. The debits and the credits in terms of the effects. Right, so when assets increase, you increase the asset, you increase the capital. Okay, the valuation account will sort itself out.
Yes.
Don't worry about that. You can literally just substitute it in, that's all. Right, as long as you remember the blue, okay, that's important. Okay, and then obviously if it's a liability, same thing. Right, if a liability had to increase, you increase the liability, you decrease the capital. Okay, the valuation accounts will sort themselves out, so don't worry about them. Are you okay with that? Are you happy with that?
Okay. Yeah, I get what you're saying. I get what you're saying. So you just So the net effect is important
The net
for
effect
the
is
assets
important,
and the
yes.
capital.
100%.
Okay.
Yeah, the net effect is very important. Unless they ask you for a valuation account, that's the only time you'll actually draw it up.
Okay.
Right. You'll never ever have to draw up an evaluation account unless they ask for it. Okay, when we
Okay.
do workings later on, when we actually look at a change in ownership, it's always done in a particular scenario where you'll have to value the company and you'd have to maybe do something like this. Calculate the goodwill. Okay, so
Okay.
that's the next concept we need to look at in terms of theory. Right, all of these concepts are covered in detail in the textbook. The notes that I've given you are just summary notes, notes that describe the most important things that you need to take out in terms of theory. Right, so the first thing is the definition of goodwill. Okay, what is goodwill? It's reputation. That's all it is. Inverted commas. Okay, it's the stuff that you can't see but that add value to the business. Right, so have a look at this. You've got A and you've got B. Okay, and this I tried to explain when I went through the assignment with you. Okay, when we looked at a goodwill calculation. Okay, here's the actual note about it. Okay, in the actual textbook, as well as the study guide, as well as in my notes. Okay, if you've got A and B, okay, A and B will have owner's equity. The owner's equity will be calculated by minusing your assets and liabilities. Is that okay so far?
Yes.
Okay. The owner's equity that A and B have in the business might come out to, let's say, 10 million. Okay. They've grown the partnership to a certain level. If we take the assets and we compare it to the liabilities, they have equity of 10 million. Okay. Goodwill is only recognized at cost. You're not going to have to worry about goodwill in any other scenario. Okay? If you do more accounting, then you will. But if you don't do more accounting, this is where it ends. Okay? What you do need to understand and know is goodwill is called purchased goodwill. And it's called purchased goodwill because it can be reliably estimated and measured. Okay, when we looked at qualitative characteristics, one of the fundamental principles in IFRS is you need to fairly and accurately represent accounting information, truthfully, reliably honest. It needs to be material. It needs to be factual. All of that stuff, right? Accuracy, right? So the only time you can ever measure goodwill is when you have purchased goodwill. So in other words, somebody is willing to pay for a portion of the business. Right, so having described it, goodwill is the reputation of the business which is influenced by factors such as the quality of the products or services, the management, the patents, the trademarks, all of the stuff that goes into running a business. Okay, what element do you think goodwill is going to be viewed as? Break it down to its basics. You've got 6 accounting elements. Which one do you think goodwill is going to be? Asset, liability, income, expense, capital, drawings. I was asking you a question about goodwill. What type of accounting element is goodwill? Do you know?
I would say an asset.
Good. Which one do you
don't
think
know,
it is?
but-
Long term or short term?
Long term.
Yes, because it's generated over time. Good. Okay, add that to your notes. If you
Just a question. Why did you say goodwill initially recognized at cost?
Okay, it's recognized at cost because it's based on the purchase price. It's based on how much a portion of the business costs. So when I say it's recognized at cost, it's recognized at the cost price in terms of the purchase price.
Okay.
Okay, that's why I've
Right.
written purchased goodwill. Yeah, so it's based on the inverted commas, what it would, inverted commas, cost someone to buy into the business.
Okay.
Okay, and we'll see that with an example, okay, just now. All right, so when looking at goodwill, okay, we know what it is. If it's a non-current asset, it'll have a debit balance. Okay, What benefit would goodwill have on the business? Would goodwill increase the owner's worth or would it decrease the owner's worth?
It would increase the owner's worth.
Exactly. Okay, notice how important it is to know what you're dealing with. If the asset is debited, the capital is
The capital.
credited.
Credited.
Okay, so owners get the benefit of any goodwill. Right, see, basics apply here. Asset increase, capital increase. Got that?
Yes.
Perfect. Right, this is some mathematics. I'm actually going to ask you, okay, to try do some of these for next week to see if you can get the right answer. I'm going to take you through one, okay, and then I'll give you the others as homework. Right, the answer is there,
Okay.
but I want to see if you can get the working. Right, so
Right.
let's do one together. A and B have a profit sharing ratio of 2 to 3. Okay, when you do
Okay.
these types of questions, you need to use fractions. This is
Okay.
the best approach. Okay, this is the only time where fractions will actually benefit you, right? Because you don't have to worry about a ratio because the ratio is actually calculated when you use fractions. If you use decimals or percentages, it gets very complicated because then you have to convert and then convert again later on. It's just too much effort. Okay, fractions might be more difficult if you don't like maths, but it's the easiest way to get the right answer if you're looking at accounting.
All
So
right.
how's your fractions?
They're okay, I guess. They're not
All
bad,
right.
and it's
Okay, we'll check your
strength.
fractions just now, and then I'm going to give you a few. You can try them, and if you have problems getting to the right answer, then let me know next week and we can go through it in detail.
Okay.
Okay, so this is how you do any question. I actually want to open up our notes and actually do it here so you can see it and you've got it. Okay, so change in ownership. NB, new and old. Right, so this is the mathematics. The maths for changes in ownership. Okay, asterisk, profit sharing ratio. All right, so this is how you do it. You write down the old and then you write down the new. Right, in the question, I said A and B have a profit sharing ratio of 2 to 3. Right, so let's test you in terms of your fractions. Right, what fraction does A have? What fraction does B have?
Okay, so A would be 2/5,
Good.
and B would be 3/5.
Correct. Right, that's the first step. When you do any question, just follow this process. New on this side, old on this side, new on that side. Okay, new and
Old.
old, new and old, new and old. That's
Okay.
all. Okay. Then you look at the mathematics in between. Right, then we need to read. Partner C is added. His share is 1/5. Relinquished according to the profit sharing ratio. Okay, so new partnership A, B, and C. Do you agree?
Yes.
Okay, how much is C going to have in the partnership?
1/5.
Good.
So 1/5.
All right, because this is the new partnership. Do you know how much A is going to have? No. Do you know how much B is going to have? No. Right, that's where the maths comes into it. So you need to take 1/5 from where? From the new or the old?
From the old.
Exactly. Right, the 1/5 comes from the old partnership. All right, so the old partnership will give up 1/5. That's what's happening here. Right, so how is A and B going to give up the 1/5? How does the 1/5 get relinquished?
I would say equally. So
No,
like
not equally. It
Not
doesn't
equally,
say
but like
equally
2
here. It
to
says
3.
according to the profit sharing ratio.
profit share. So 2 to 3.
Okay, so the 1/5 is relinquished according to the profit sharing ratio. Right, so how do you do that? Here on the next line. Okay, on the next line, you have to show that. All right, so how much is A going to give up? A is going to give up 2/5 of 1/5. Does that make sense? Are you still there? Does that make sense?
I am 2/5 of 1/5.
Yes, they're giving a fifth, but they're giving a portion of the fifth. They're giving 2/5 of that portion.
Okay.
Okay. How much is B going to give? 3/5
3/5
of the 1/5 that they're giving. Does that make sense?
Yes.
All right. Then you do your mathematics. Right. On the next line, let's show it. Okay. When I have of, what does of mean?
Times.
Yes. Okay. Then you multiply. All right. Numerator times numerator. 2 times 1 is 2. Denominator times denominator
25.
is 25. Are you happy with that?
Yes.
Okay. Numerator times numerator is 3. Denominator times denominator is 25. Are you happy with that?
Yes.
Okay. So, how much does A relinquish? A relinquishes
2
2
over
25ths.
25.
How much does B relinquish? 3 25ths. Okay, when you have different denominators, what do? You need to
You
get
can increase.
a lowest
the
common
common
denominator. Do you agree?
Yeah.
LCM. Okay, so how do I get a lowest common denominator or lowest common multiple? How do I convert fifths to 25ths?
Times 5.
Good. Okay, so
I would actually
10
do it
over
the other
25.
way. And I get what. Yeah, I would do it that way because that's just the way I do it.
okay, it doesn't matter which way you do it. I'm just showing you the method that works. Okay, if you've got a
Okay.
different method
And
and it
then
works,
it's-
then use that method.
No, I'm saying this is how I would do it.
Oh, this is how you would do it. Okay, great. Yeah, then you're doing it the correct way.
Yeah.
Okay.
Okay.
All right, so
So then 8 over 25.
yes. Okay, so see, 10 minus 2 is
8.
8 over 25. Okay, 15 minus 3 is
12.
12 over 25. Can I work with different
Okay, and then
denominators? No, I can't. Convert
No.
this to 25ths. So times it by 5.
So 5 over 25. There we are.
Yes. And now if you have the same denominator, you automatically get the profit sharing ratio. A to B
Okay.
to C is 8 to 12 to 5. Do you see that?
Yes.
All right, and that's the answer. Okay, well,
My only
simplify it.
question.
You can simplify it. How can I simplify this? Let me see. I've
You
done
can't.
something. I can divide by what? Let's check. Let me see here. This was 10, hey?
Oh, okay. Oh, no,
25 times
I
5 is
see
10?
what you missed.
Oh,
You
okay,
missed
yeah.
partner C relinquished by each partner equally.
Oh, hold on. Wrong page. There. Sorry.
Oh, okay.
I was on this page. It's the other
Yeah,
one.
that's I'm like 50-50. I didn't read that. Right.
Yeah, no, it's right. Okay, that was
Yes.
the second example. This was the first example. Yeah, the first example is correct. 8, 12, 5, 8, 12, 5. You can see it there.
My only question would be, what if partner C share had a different denominator? Would we get that?
Well, then you just have to use the lowest common denominator to get the same denominator. It must be so basically the answer that you get must all have the same denominator.
Okay, I understand that, but like in the question, say if they, for example, if would there ever be like partner C added his share which is 1 over 6, for
Here,
example.
here's a good
we
one.
get that?
There, this one you can try. 3 over 8, 5 over 8, and someone's getting 1 over 4.
Okay.
Yeah, here's exactly what you're asking.
I times it by 2, make it 2 over 8.
See, your maths is good.
Okay.
As long as you can play with the fractions, you'll get the right answer.
Right.
Okay, so are you up for the challenge? Do you think you can do these on your own, and then we can check it next week? If you have problems, I'll go through it with you.
Okay, I'll do it for homework and we'll check it next week.
Yeah, so this one, please try that one. This one is 50-50. That's the answer that you should get. Okay, so if you're not getting it, try again. If you're still not getting it, next week I'll go through it in detail.
Okay.
Okay, same with this one. Okay, try it, see if you get it. DEF, that's the answer. If you don't get the answer, try again. If you still don't get the answer, I'll go through it in detail next week.
Okay.
Here's some more for you to try. There's quite a few because this is maths. You saw it came up in the assignment. It does come up.
Yes.
Right. When you are, and it probably will come up in a multiple choice because you're writing online. These are the type of questions they can ask as a multiple choice. Okay, so please try that. Okay, and if you want a challenge, here's the challenge question. This also came from the textbook. This is probably as hard as it will get because now you have 4 partners instead of 3.
3, okay.
Right, you've got Tava, Pinky, and Thuli, and now they're also bringing in someone else, Eunice. Right, It's actually a textbook example, but it's a nice example. It's more maths than accounting, but it's a challenge. Okay, see if you can get the answer. If you don't know how to get the answer, I will go through it with you. Okay, you just have to read the question carefully and follow the steps. If you follow the steps, you'll get it.
Okay. I'll try it. I'll definitely do it.
Awesome. All right. And then just a few other notes here, and then we've covered the theory, and then we can look at practical. Okay, so the notes just serve as theory, so you can go through the textbook as well as the notes and the study guide, and then we need to go to the study guide to do the practical. Okay, and that's where we bring in the exercise and examples, and we cover that. All right, so we almost finish here in terms of theory. The last part here in terms of changes in ownership. NB. We spoke about partner-specific transactions. What are partner-specific transactions? Do you remember?
Not really.
Okay, something that only relates to one individual partner. So in other words, don't ever consider personal transactions. Okay. So in other words, okay, when looking at transactions being recorded in the partnership, okay, when we looked at the statement of changes in equity, okay, what did we put in the statement of changes in equity? We put in partner-specific transactions. Remember that. And then in the SOCI, yes, the comprehensive income, and the SOFP, the financial position, what did we show here? Business. Do you remember?
Yes.
Okay, so when you look at a change in ownership, the same things apply. Okay, you only show business as business. Anything that's separate is separate. Okay, so when you have A and B, only what A and B are doing in terms of the partnership will be recorded in the partner's books. Right, so transactions are recorded. Which transactions are recorded in the books of the partnership? Only partner-specific transactions. So in other words, okay, when you're looking specifically at the partner, what is the partner doing with the partnership? If it's separate, it's personal. It's not business. If it's business, then it's recorded in the books of the business. Right, so when I had a SOCI, okay, and when interest was charged on a partner's account, was that a partner-specific transaction?
Yes.
Yes, it was. Okay, was it for the business?
Yeah.
Yes, it was. Okay, but you can have a loan where partner A takes out a loan, okay, and that loan has nothing to do with the partnership, right? It's external, it's outside, it's outside the business. Then you're not going to consider it. All right. So just remember,
Okay.
whatever's business is business. Whatever's personal is personal. Okay. If partner A is going to take out loans in their own capacity, it's their own loan. It's not the partnership's loan. Right. That's a separate loan.
Um,
This could be loan external bank. Okay. If partner A takes out a loan
what would
with the
happen?
partnership, then it's a partnership specific loan.
Yeah.
Okay, so just be careful.
What that?
Remember, it's separate or it's. In other words, when I say separate, it's either separate from the business or it's with the business. Does it make sense?
Yes.
Okay.
Just a question, Anthony. If a partner had to take a loan from the partnership, how would he or she record it?
Okay. Yeah, you do have to record those things. Right. Those things are disclosed later on. Okay, you'll record that as a statement of changes in equity line item. You'll see a loan to partner A or a loan to partner B. Okay, they don't really cover that in partnerships,
Right.
but they cover it in members, right? Where you have a loan with a member, not a loan with a partner.
Okay.
Okay, yeah, so you're going to have to wait till CCs for that. It'll be the same with the partnership though. Okay, you'd have to record it separately. It'll have to be a separate line item in the statement of changes in equity because it links to the partnership, not to the partner themselves. Okay, so if it's totally separate, it's separate. If it's got anything to do with the partnership, it's part of the partnership.
Okay.
Okay, all right, but yeah, you won't see that in the partnership, but you'll see that in the CCs. Yeah, but we'll discuss it when we look at that. Okay.
All right.
All right, and then just a note here: recording a change in ownership structure. This is something we'll look at when we actually go through the examples. Right, I've tried to summarize it here in terms of two different perspectives. You've got a legal perspective and you've got a going concern. Okay, the difference is the new ends, the old ends and the new starts. Okay, the new begins. Here, the old books become the new. Right, so which is better? Well, if you're looking at the actual agreement, okay, which option is better? This one, the legal. Why? Because remember we said if you sign a new agreement, what happens to the old agreement?
Falls away.
It falls away.
Dissolves.
Exactly. Okay, so when you look at the legal perspective, you're basically saying this is the partnership A and B. Okay, they're running a business and they have accounting records. Okay, if we're going to change it to A, B, and C, what are we going to do? If I use the legal perspective, I totally eliminate A and I start new. That's what you're saying here with the legal perspective. Right, so when you have the legal, you literally close off everything. Right, and this kind of links to what you asked me earlier about closing off land and buildings. Okay, would you ever close off land and buildings? You would if you're starting fresh. Right, and if you're looking at it from a legal perspective, then you could have that. You could have land and buildings being closed off because you close off everything, okay, you record goodwill, and then you start new. All right, and you'll see that in some examples. Right, if it's the going concern, this I don't see them test that often.
Okay.
Okay, what else do you want to say there? I heard something. Do you have a question? I heard you say okay. Are you alright?
No. Yes, that's all I said. I just said, oh, okay.
Okay. Alright, yeah. So the going concern means the old books are used for the new. So same as before. A and B. Okay, accounting records. What are we going to do? We're going to keep the accounting records. And we're just going to bring in C. Right, so the old records become the new records. We're not going to dissolve the business and start new. Okay, this is ideal. Right, start fresh. Get rid of the old, start with the new. Right, and it makes sense because it's a legal perspective. Remember, when we spoke about the contract, you literally have to sign a new contract. New contract, new start, new partnership. Right, so this process is preferred. but you can take the existing and just adapt it for the incoming partnership. Right? It's slightly different, but it can be done either or. Okay, what are we looking at here? We're looking at the accounting. Okay, we're looking at the record keeping.
So, for going concern,
Yes.
is that when a partner would buy into a business?
Okay, remember, it doesn't matter what perspective you have, legal or going concern. Right, whenever you have a new partner buying in, so if a partner buys into a partnership, okay, they have two options. They have option one, use the legal perspective, or they have option two, use the going concern. Right, this is looking at the record keeping.
All right.
Okay, the accounting. That's all. Right, so whether you're accounting for it like a dissolution or whether you're just reinstating and adjusting and creating a set of records that have A, B, and C, it's still the same thing. Okay, so whether you're buying in, the buying in is going to create either a legal perspective or a growing concern perspective in terms of the accounting that needs to be processed.
Okay. I understand what you're saying.
Yeah, so this is just like a method. It's like straight line or diminishing balance. It's a method to approach a change in ownership. That's all it is. Happy?
Yes.
Awesome. Okay, and this you'll see when we go through examples. All right, it's not that difficult. You can even keep the steps with you because it's open book if it's online, and you can just follow the steps if you need to go through a legal perspective or a going concern perspective. Right? If it was closed book, then you'd have to remember it, and that can be quite challenging. All right, and then the last bit is what we had looked at in the actual assignment. This is an assignment formula. Okay, I even refer to it. This is an important slide to study. Okay, there's a formula here. Right, what is the formula? Here's the formula. Total consideration minus total equity of the new equals the goodwill. Okay, so goodwill equals total purchase consideration. That's how the textbook refers to it as. Okay, so in other words, the 100%, the total value, the value of the business looking at the purchase consideration. Right, so if I buy a share of the business, let's assume a new partner is buying a third, okay, and they're paying $1 million. Right, what is the 100% total purchase consideration? It would be 1 million times 3, which is 3 million. Does that make sense?
Yes.
Okay, and then you've got to compare that to the total equity. And then equity is looking at owner's equity, which is assets minus liabilities, or it could be owner's equity in terms of capital and drawings and all of that.
Okay.
All right, because remember, you've got two equations for owner's equity. You can either work it out using assets and liabilities, or you can work it out using capitals, profit and loss, okay, drawings, and that type of thing. Right. It doesn't matter which one you use. It just depends on the question. Right, but it's the equity for the business. Right. Assuming the equity was, let's say, 2 million. Okay, 3 million minus 2 million equals 1 million in terms of goodwill. All right, so I've done one example with you, but that was from the assignment. Right, if you go back and you look at that assignment again, you could probably work it out. But we need to do some examples first. Right, and we'll use the textbook to do that. Right, happy with that section in terms of theory?
Yes.
Awesome. Okay, we have a few minutes left. Let's have a look at one example so we can see how this works. Let me go back to the textbook. Here's it. All right, we'll go through the rest next week. I just want to look at one. Okay, the first thing we covered today was the valuation. Here's it. Right, they've given you notes from the prescribed textbook. Okay, so the study guide is helping you to go through the content. Okay, the notes that I've given you in terms of PowerPoint, okay, that's just to supplement everything that you've got. Right, so when we spoke about valuations earlier, hopefully there's an example here. Let's see if there is one. Yes, there is. Here, there we go. Recording valuation adjustments. Okay, it's on page, what page is this? Page 74. Okay. Right. Can you read the question for us and highlight things that are important?
Yes. Okay, so Stevie and Bob are in partnership. Wonder traders, and they share profits and losses in the ratio 3:2, respectively. I'd highlight that.
Very good. Why?
Because it's important. It's how they're going to share their profits, and when a new buyer comes in,
Correct.
it's
Okay,
the
so remember
old.
we said draw a diagram?
So it's the old. Yes.
Yes, that's the key. That's what I'm looking for. Good.
Oh, it's the old.
Exactly.
Okay, so then
Draw the
I'd
diagram.
have Stevie 3/5.
Yeah, write in the
Bob.
two partners.
It's 2/5. They decide to
Yes.
admit Tina as a partner as from 1 March 2015. The profit ratios for Stevie, Bob, and Tina will be, okay, they give it to us, 3:2 to 1,
Correct.
respectively.
Good. Okay, that's important. Do you agree?
Yes. So
Okay, what's it going to be? It's going to be 3 over what?
6.
Good. Okay, nice. Okay, all over 6.
Yes. Yes. 2/6 and 1/6.
100%. See, the diagram's important because that's going to help us later on. Okay, so are you happy with what we've read so far? Profit sharing ratios, new and old. You need both when you have a change in ownership.
Okay.
Okay, make a note like this. This would be a little working that I would do for myself just to make sure that I can see what the old looks like and I can see what the new looks like.
Okay.
Okay, carry on. What else do you have here?
The following information appeared in the accounting records of Wonder Traders immediately prior to the recording of any valuation adjustments.
Good. So what does that tell you? These balances are for what? For the new or for the old?
Old.
Good. Okay, do you see how important that is?
Hello?
Yes, I'm here. Do you see how important that is?
Oh, okay. Yes.
Okay, good. All right, so there, I've just made a note. Check the assets and liabilities. All right, so land and
Yes.
buildings. How much? 30,000.
30,000.
Okay, debtors or trade receivables.
Debtors. 26,000.
Okay, inventory.
Inventory 44,000. Bank 20,000. Okay, and then it's capital for Stevie. 60,000.
Yes. Okay, but remember, capital is not assets and liabilities. That's why I'm showing it separate.
Yes.
Do you see how I'm doing it?
Yes.
Okay, so it's important to identify assets and liabilities separately because obviously you'll have two different things, right? So trade payables is a liability. That's going to go here, 20,000. Okay, capital Stevie, 6,000. Capital Bob, 40,000. Okay, if you add
40,000,
up the equity, have a look at this. This is something to note. There's a reason why I'm drawing this diagram so you can have a better understanding. Okay, owner's equity is how much
Okay.
here? 60 plus?
100.
40,
Yeah.
yes.
This
Okay,
is
would you
100,000.
agree that should equal the assets and liabilities?
Yes.
It should. Okay, remember?
Yes.
Liabilities, negative. All right, so if you're looking at assets, okay, 30 plus that plus that plus that gives you 120. Do you see that?
Yes.
Okay, this is important for later on when we do other things. All right, total liabilities, 20,000. There's only one. Okay, so owner's equity equals A minus L. So 120 minus 20 is 100. Do you
100.
see that? Okay, and this is for the old. This is for the existing partnership. Does that make sense?
Yes.
Okay, good. All right, so now what do we have?
Okay. Additional information. To
Good.
prepare for the change in ownership structure of Wonder Traders, the following agreement was reached on the 28th of Feb 2015. An allowance of 2,600 must be created for credit losses.
Okay, what is that going to do to our books? Give me your working.
It's going to take away from our trade receivables.
Okay, yes, but what would the debit and credit be?
So you're going to debit credit loss allowance for credit losses.
Debit, credit,
And
yeah?
you're going to no, you're going to
Isn't allowance for credit losses a negative asset?
it is, but then wouldn't that be for expenses?
Debit you don't have expenses here, you're not operating.
Because I would credit trade receivables.
No. Ooh, be careful. That's disclosure. Okay, what did we say we're doing here? We're recording what? An allowance. Right, how do I show an allowance? With the credit, do you see that?
Yes.
Okay, so what are you going to show? You're going to show a valuation account. Because when is this taking place? When you have changed the ownership of the business. You have reached the following agreement in terms of the valuation. They believe that the debtors are actually worth less than what they actually are. So I need to show the allowance for credit losses. Okay, it's an allowance, it's not a write-off of bad debts.
Oh, okay.
Okay, because remember, this is a change in ownership. So when you have a change in ownership, you have these valuation accounts. What is this going to do to the capital in the business?
It's going to decrease it.
Yes. Okay, why will it decrease it? Because you can just picture this. Okay, credits the allowance, debits the capital. Okay, the net worth has decreased. Capital, Stevie/Bob. Okay, credit,
But would
valuation accounts. Yes?
so my element for allowance for credit loss will still be a negative asset.
Correct. Because this will be offset against the asset.
Right.
Okay, because they're talking about an allowance for the credit losses. They're not talking about writing off bad debts.
Okay.
Had you written off bad debt, then I would have shown debtors and credit losses. But that's different. It's not, I'm looking at the assets and liabilities of the business. Okay, are you happy with that one?
So will there always be two, like, transactions? Can I say that?
Will there always be two transactions? Well, yes, if you're doing it this way, because it's easier, because you can see both. You can see the credit and you can see the debit, because those two things will eliminate themselves out.
Okay.
Okay, the reason why I'm showing you both is because if you're having to draw up T accounts, or if you're having to record this in the accounting records, you're going to have to show both sides of the account, because every debit has a credit. But the valuation works itself out. So you don't actually see the valuation, but you see it as a working.
All right.
Right, to get the working, you need those two things. You need the debit there and you need the credit there.
Okay.
Okay, so it's worthwhile to keep it separate. All right, let's do the next one. Number 2, what's happening there?
Okay, so inventory must be recorded at 50,000. Oh, so the inventory is worth more than it actually is.
Good, so how do you increase the value of inventory?
Debit it.
Good.
And would you do it at 6,000?
No, before we look at workings, just get the right debits and credits first. Forget about the amounts, just give me the right...
So then we credit valuation account?
Yes. And then?
Okay, and then debit the valuation account and credit capital.
Yes, why?
Because capital's increasing.
Exactly. Okay, if the buildings increase in value, we said the owner gets the entitlements. All right, so Bob and Stevie are going to enjoy, okay, an increase in their entitlement because of the valuation of the inventory. Does it make sense? Are you with me?
Hello? You're breaking up a bit, Anthony.
Okay, sorry about that, y'all. The connection, I apologize, y'all. The connection today hasn't been so great at certain times. Are you
Hello?
happy with that? Stevie and Bob get an entitlement because their assets have increased in value.
Okay.
Happy with that?
Yes.
Good. Okay, last one. Tell me about this one.
3. Land and building must be recorded at 50,000. Okay, so land and building is increasing. So you debit land and building,
Correct. And?
credit the valuation account,
Yes. And then?
debit the valuation account, and credit capital.
Very good. All right, so look how easy that is. As long as you can remember what's happening, okay, you can get it. All right, so just remember, it comes back to what you saw in those notes. Okay, valuation is just that. It's a working account. It always works itself out. All right, the important bit is looking at the actual amounts. Okay, so what is the amount here? 2,600. All right, so if I'm recording that, it's going to be 2,600 there, 2,600 there, 2,600 there, 2,600 there. Right, because I'm showing these workings, I've got everything. So it doesn't matter what I'm going to have to do, I have everything that I need in the actual question. Okay, the inventory, 50,000. If you look at the inventory, we saw it earlier. Okay, the inventory here was 44. So what's the increase?
Yes.
What's the difference?
6.
Good. Okay, so what am I going to show here? I'm going to show 6 there, and I'm going to show 6 there. I'm going to show 6 there, and I'm going to show 6 there. Okay, land and buildings. What is the land and buildings? 30. What did we say it's valued at? 50. What's the
50.
increase going to be?
20.
Good. 20 there, 20 there, 20 there, 20 there. Okay, just remember, when you're allocating this, you need to split it. All right, so how much does Stevie get and how much does Bob get? We saw it earlier.
What was the...
Here's it.
3:2.
3-2, correct. So 3/5 for
Yes.
Stevie and 2/5 for Bob. Do you see that?
Yes.
Okay, so where I've highlighted
So-
the yellow.
So we'd add that to the capital accounts.
No, you wouldn't add it, you would just split it.
Okay, but say we split it now, would it not be changed in the statement of changes in equity?
Disclosure wise, remember this is a change in ownership, so you're dissolving the business and then you're starting new. Because you're bringing in Tina. Are you with me? It's a change in ownership. Are you still there?
Yes.
Okay. I'm changing the form of ownership. I'm changing what we have here from Stevie and Bob to Stevie, Bob, and Tina.
Yes.
All right. So who gets the benefit of the valuation? We spoke about it earlier today.
The old. So
Good.
Stevie and Bob.
Yes. So don't forget to use the right ratio. Don't use this ratio. Use that ratio. Right. So this is 2,600 times 3/5. That's Stevie. Okay. Bob gets 2/5. Right. That's how you show it. Right. Same thing here.
Okay.
Okay. Stevie gets 6,000 times 3/5.
3/5.
Okay, and then Bob gets the difference, 2/5. Same thing here. $20,000 times 3/5. 20,000 times 2/5. All right, does that make sense? Are you happy with that?
Yes, that makes
Okay,
sense.
the workings are so important. Those workings are needed to do this question. Okay, so what did the question ask you to do? Let's go read it. Prepare the following accounts properly balanced. Okay, so here they want general ledger. Do you see that? They want T
Yes.
accounts for land and buildings. Okay, land and buildings will have what balance? Give me the balances.
Debit. It's
Inventory,
an asset. Debit, an asset.
trade receivables,
Debit, an asset.
allowance for credit losses,
A credit.
yes, credit,
Negative asset.
good. Capital,
Credit.
good. Okay, so let's have a look at their workings. Here, there's the land and buildings. Right, so where's my workings? Here's my workings. Okay, do you see how important it is to show workings? Right, what are you going to have in land and buildings? In land and buildings, you're going to debit land and buildings with valuation. There's the contra account. In land and buildings, I debited land and buildings with valuation account. Do you see it?
Yes.
Okay, there's your working to support your answer. Right, when you get comfortable with this, you don't even have to show the working, but I like to show workings because it helps students to get the answer. Okay, just remember you're increasing the bank, it must be debited. So bank, not bank, you're increasing the land and building, so it must go on the debit side.
Debit side.
Okay, but you're referencing it because of the valuation. It gets complicated when you see the valuation accounts. Right, so that one might be easy. That one you don't have to do a working for because you'll know it. Is that one all right?
Yes.
Okay, have a look at inventory. There's my working to support the answer. They've done it correctly as well. They've debited the inventory and credited the valuation. Do you see it?
Yes.
Okay. Trade receivables, nothing. Notice you don't debit trade receivables. We spoke about this. You wanted to, but you can't. Okay, because it's an allowance. It's not bad debts. Okay. Does it make sense?
Yes.
All right, this is disclosure. When you disclose this in the statement of financial position, you will show trade receivables at 26, and then you'll show a minus 2,600, like what we've done there. Happy with that? Happy with that? Do you see that? Do you see the working?
You broke up a bit, sorry.
Okay, do you see the working? The working supports the answer. Okay, you're crediting the allowance. There's the credit for the allowance. Okay, why am I crediting the allowance? I'm crediting it because of the valuation accounts.
Yes.
Okay.
Yes.
All right, here, valuation account. Notice in the valuation account, it's a working account. So let me highlight the working account. Okay, this is a credit. There's a credit. Here's a credit. Okay, here's a credit. All right, so when you look at the valuation account, here's my valuation account. All right, in my valuation account, okay, I credited the valuation account with inventory 6,000. There's the credit. There's the contra accounts. Okay, here's the contra accounts for the valuation. Okay, and then in the valuation accounts, okay, this is for the capital. This one is the debit side. You're debiting with the split. Okay, the split is looking at this part. Okay, I'll show you what it'll look like. Let me do it here. Let me just highlight the debits. Okay, I'll show you what it looks like. Okay, I see they've taken the shortcut. They haven't shown as much. Right, this is what my evaluation account would have looked like. Okay, it doesn't matter if you put more workings or if you put less workings. They've just offset some of these. That's why they don't show as many of those adjustments, which is a pity, okay, because then you lose out on some of the basics here. Okay, so let me show all of this. What color? Yeah, that's the right tint. Yeah, that's the right color. I hope. Looks the same. Okay, so I had the inventory. I had the land and buildings. Actually, just write it in. Otherwise, you have the debits and credits. Okay, and you had the capital. Capital S and capital B, Stevie and Bob. Okay, so inventory here, where's the inventory? 6,000. Okay, the land and buildings, 20. Capital,
20.
Stevie, capital Bob. There we go. Right, and then you need to show the debits. Okay, so in valuation, all right, I had the credit allowances. Allowance. Credit losses. Okay, that amount was 2,600. Well, what else did I have? Okay, I had a debit here for Stevie and Bob and a debit there for Stevie and Bob. Okay, so you can show them separate or you can add them together. I'm going to show them separate. All right, so this one, Stevie got that, Bob got that. Stevie got that, Bob got that. All right, so that's what I would have shown in the valuation account. Does the valuation account still balance? Yes, it does. Okay, if you add up everything, you get that. If you add up everything, you get that. All right, it has to balance, right? Because the benefit goes to the partners, or the partners, right? What they've done is they've just offset these accounts, okay, with those ones, all right? So what UNISA has done in their solution, they've just added and subtracted that. All right, so they've taken this account and they've simplified it. All right, they've shown this, they've shown this, they've shown that. Okay. I need to delete this. Delete. Okay, they've shown one working for it. Okay, but then UNISA needs to show a working. Okay, in brackets, UNISA should have shown this. 3,600 plus 12,000 minus 1,560, close brackets. Okay, do you see why? It's this amount plus that amount minus that amount. Do you see it?
Yes, yes.
Okay, same for Bob. Right, so it doesn't matter how you do it, as long as the working account works itself out. Okay, so their solution looks quite different to ours. I would have shown that because I would have had those workings. Okay, those workings are the answer, and then you just need to adapt it to the question. Okay, so if you go back, okay, in their valuation account, they've got something that looks like that. Yeah, it's the same thing. See? Okay, they just haven't shown capital Stevie and Bob on both sides. Right, it's better to show it like this because you can actually see what you're doing. You're allocating the benefit or the detriment to either or. Okay, to either Stevie or Bob. Bob enjoys, okay, a benefit from the inventory and the land and buildings, and so does Stevie and Bob enjoy a benefit. Do you see that? And then here, there's a detriment. Okay, they lower their value. Make sense?
Yes.
Okay. Right, and then in the capital account, they'll obviously have a balance plus whatever they're getting. Right, and then obviously, again, I'm not going to show it like this. I would have shown it separately. Right, what I would have done is I would have shown Stevie's account and Bob's account separate. Okay, I would have shown this. Okay, in Stevie's account, we need his balance. Okay, Stevie had 60 and Bob had 40. All right. In their individual accounts, I would have referenced what they had. So, debit capital S with that amount. Okay. Debit capital S with that amount. All right. And then I would have had credit valuation. All right. This valuation was for the allowance. Okay. This valuation was for the inventory. And the other one was for the land and buildings. Are you following? Does that make sense?
Yes. Yes.
Okay, so I would have shown it separately and then you would have got the same thing. It doesn't matter. More detail is better than less detail. Okay, so I would have done it this way. The inventory would have been Stevie's portion. Stevie got 3.6. Okay, his land and buildings 12. All right, and then you would have had the same thing here. Okay, for Bob. Bob would have had his share of the allowance, his share of the inventory, the benefits. Where's his inventory? Here's his inventory. And his share of the land and buildings here. No, there. Okay, this needs to change. It was there, Bob. Okay, hopefully it's the right amount. Yeah, Bob, good. All right, and then if you balance these accounts off, okay, obviously this side is bigger than that side. All right, there's the total. That's the total. Okay, write the total on both sides. Balance brought down, carried down. Okay, and that should be the same as what they've got. Let's see. Yeah, there's capital S. So Stevie had 74040. There's it. Do you see it? And
Yes.
Bob had 49360. Do you see that?
Yeah.
Okay. Are you happy with that? Does that make sense?
It does.
Okay, good. All right, so keep these workings. You can use them in future. This is the key. That one slide that I had given you in the notes where you've got the debits and credits and I've highlighted the valuation account. Right, that whole slide is just to show that. It's to show that the valuation account works itself out. Right, so if you keep it simple, if you know what you're debiting and you know what you're crediting, you'll get it. Okay, earlier when you did these workings, you told me exactly what to do. Okay, you said inventory goes up, capital goes up. You told me land and buildings goes up, capital goes up. Then just throw in the valuation. Credit, debit, credit, debit, credit, debit, and then you automatically get T accounts if you need the T accounts. Okay.
Okay.
Happy?
Yes.
Great. All right, let's save that. I'll send that to you now when we wrap up. Is there anything else? Let's just see what the next one is. Okay, the next one's a bit long. Yeah, that's going to take us a while to get through. We're not going to have time today. All right, so I'm going to leave that for next week. We can continue with 4.2,
Okay.
and then we've got probably more as well. Okay, the exercises are quite long, right? If you've looked at them, you'll see they're a bit too long for us to cover. We're not going to have time to go through all of it today. Okay, but hopefully it makes sense. Happy?
Yes. I just wanted to confirm, next week are we going to be going over the assignment?
Yeah, we'll have to because you obviously need it, but a lot of it you might not be able to do, and some of it you might. Let me bring up the assignment and see what the assignment is looking at.
Because it is due on the 21st.
Yes. Okay, so next week is the 15th. Yeah, I did make a note on the calendar. I do see it. Let's just see what questions. So let me see which questions you can do, and that could be some homework. Okay, because there's nothing else that you have to do other than revise and go through the content. So try complete. Okay, here, semester 2, assignment 2. Obviously, the date has changed. You mentioned that last week, or the week before, actually. All right. Question 1, 2, 3, and 4 looks at what? Okay, this is disclosure for members' contribution. All right. Obviously, you're not going to know how to disclose the members in terms of CCs, but adjustments you can do. Okay, so when you have tax, that you can probably provide for. Right. So workings you can do here in terms of things that aren't paid and things that are paid. Right. Obviously, tax, you'll have unpaid tax, which is a liability, okay, or you'll have paid tax, which is an expense. Let's see here. Okay, the loan you can do. This you should be able to work out. Okay, if there is a working it. Interest payable, there might be accrued interest. I don't know what this is. We'll look at it next week. Okay, we'll do it together. Okay, I'm just looking at what you can do and what you can't do. 2.4, that adjustment you can do. All right, so adjustments you can do. Please try them. All right, so look at the adjustments. Don't worry about disclosure. I can do that for you. We can discuss it. But you need to be able to go and work out or calculate interest. That's something you should be able to do. Same thing with the loan. Something you can do. Okay, the members' contribution, don't worry about it. We can discuss it next week. I'll show it to you. All right, the disclosure for CCs are actually very simple. The disclosure is actually identical to a sole proprietor. The only thing different is vocabulary. Instead of talking about capital, you talk about members' contribution. Instead of talking about drawings, you talk about members' distribution. Okay, so it just changed the vocab. Retained earnings, you won't know. Okay, so one you can't do. Which of the following represents the correct amount disclosed as non-current assets in the statement of financial position? That I think you can do. That'll be looking at assets, property, plant, and equipment. Okay, it's a non-current asset. So non-current assets, any tangible assets. So question 2, you might be able to get right. Okay, you might be able to get an answer. 2, you need to try. Okay, try 2. 3, current assets, that you can also try do. Right, that's just a normal disclosure question. See if you can work out the current assets for the statement of financial position. Right, try do as much of it as you can. You might even get the right answer. If you don't, you might get close. Okay, but we can see it next week. You can try it, and then we can look at it next week. Current liabilities, also something you can do. That you can disclose. Okay, that's looking at interest. Okay, we saw interest here. Okay, there might be other accruals as well. Okay, because remember, current liabilities means things that are unpaid. Okay, so you might have accrued expenses. You might have income received in advance. You might have other. Okay, just look at the question, see what they've got, do the question, see if you can get something similar or exactly. Okay, question 2. Question 2 is looking at shares. Not 2, question 5. Okay, don't worry about question 5. You won't be able to do that. That's companies. Question 6, you won't be able to do. That's also companies. Question 7, 8, 9, and 10. What is this looking at? Okay, cash flows you can't do. That you can ignore. Okay, the rest of it's cash flows. Yeah, you're not going to be able to do any of that, right? So I see they haven't tested partnerships again. Okay, they've tested it in assignment 1. They haven't tested it again. All right, so the only ones that you can do are the first 4 questions. Well, actually, the first 3.
Okay.
Right, question 2 you could possibly do. 3 you could do. 4 you can do. Right, the rest. Okay, what I will do is I'll do the assignment. I'll send you answers, and then you'll have the answers, because it's impossible to go through all of this before then. It's just not possible. Okay, and then when we do it, you can just go back and you can redo those questions. So this is a challenge. Okay, assignment 1, I did it for you. Okay, we've now covered changes in the ratio. Okay, so if I go back to assignment 1, okay, right, and you've got the answers. I've given it to you. You can check your answers. Right, so if I was you, I would try do assignment 1, because now we've covered a lot of it already. Okay, obviously the liquidation we'll leave for next week. Okay, because we can cover that. Okay, I'll just send answers then for the assignment.
Okay.
And then we can discuss the workings for the ones that you should have been able to do in terms of basic calculations. All right, so
okay.
Assignment 1. Question 1, you can definitely do now. Question 2, you can definitely do now. Question 3, you can definitely do now. Question 4, you can definitely do now. Question 5 is a working calculation question. I gave you some homework ones to do. All right, if you try this as a practice one, you'll probably get the same answer as we got in the assignments. All right, test yourself. Try do it and then check it with the solution, with the answers I sent to you, okay? Question 5, you can definitely do. We've covered the content for it. Right, you just need to practice. Okay, if you have problems with those examples in the study guide, not study guide, in the study notes, right, let me know next week and we'll go through them. Okay, but you've seen me covered it. It's still here. Right, this is the approach. Okay, new and old, and then the relinquishing in between. That's the approach. You just need to practice the mathematics. That's all. All right. Okay, Cheryl, are you still following? Are you okay?
Yes. Yes.
Okay,
yes.
awesome. All right, so please go back and try redo those assignment questions so you can actually see, okay, now that we've covered this, now that I know how to adjust for those changes in ratios, you can actually test yourself and see if you get the same answers as what I had got previously. Okay, so number 5 you can do. We've covered what you need to for number 5. Number 6. Okay, number 6 we haven't got to yet. Okay, this will probably only get covered next week. Right, next week I'll obviously cover the rest of chapter 4. Okay, we're almost there. I think we've got about 2 or 3 or 4 exercises. I don't know how many they've given you, but there's a few. We've looked at 1. Okay, 2, 3, and that's it. Okay, so those 2 we can cover next week. It won't take too long to cover those. And then we can obviously start with 5. 5 is looking at liquidation. So after next week, you can come back and you can look at some of these questions. Okay, so 1 to 5 you can do now based on what we've covered. Goodwill, we spoke about it today. We haven't looked at the detailed calculation. We will next week when we've looked at the rest of chapter 4. Okay, chapter 4 covers question 8 from the assignment. Number 9, okay, this one you can do. Number 9 you can definitely do because we just did it today. We went through the valuation account. We spoke about those workings. If you get the right workings, you'll get the right option here. Okay, 9 you can do based on what we've put so far. And let's have a look at 10. 10 is a liquidation. You can't do that. All right, so yeah, there's the first 5 questions, including question 9, you can do based on what we've covered so far. Right, so if you're wanting to go back and try practice, go back and try do question 1 to 5 in your assignment and question 9. Based on what we've covered to date, you should be able to manage those questions based on what we've covered. It might take a bit more practice, but obviously next week I'm going to cover more with you. I'll cover more in terms of chapter 4. We'll look at the rest of those examples. Okay, we've got 2 there. Okay, 3.4 and 3.2 and 4.2 and 4.3. Okay, sorry, I'm getting a bit tired. It's been quite a long day, but yeah, the numbers, the brain's the brain's going to sleep. Yeah, so it's 4.2 and 4.3. Those are the 2 that we'll look at next week, and then we'll cover theory, and then we'll look at the start. Okay, we'll start with study unit 5 next week. All right, so we're still on track.
Okay.
There's lots of time, so I'm not worried about that. But obviously, the sooner we get through the content, the sooner we can look at past papers and exams. Okay, and that's where everything comes together because those are the right level questions that you need for your actual exam. Okay. All right, Cheryl, any questions, comments, thoughts?
No, I'm good.
Perfect. All right, so no homework for next week. All you have to do is literally just cover those little workings. Those are things that you can maybe practice. And then if you want to go back and look at the assignment, you can look at that. Okay, but there aren't any other activities you need to look at. It's just the workings from the notes and then the assignment if you want to. Right, there are some questions, but there's not a lot. It's literally 3 questions. You can't do more than that, but then I'll just send through the answers and then at least you've got that. And then when we look at it later on, you can always go back and you can do it again. All right, so for next week, only those 4. Those are the only, those 3. Those 3 questions, 2, 3, and 4, those are the only 3 that you can actually do based on your knowledge currently. All right, in terms of disclosure for adjustments. Okay, those are adjustment type questions.
Okay.
Okay. All right, Cheryl. Happy?
Yes.
Okay. All right. Thank you very much. Take care and stay safe until next week. I will email you what we did today. This file. I'm just going to save it again, just so that I've got everything. And then you can have a look at this to help you go
Okay.
through some of those previous examples we looked at.
Yes.
Perfect.